Good morning, everyone. It is 9 a.m. live from the Nasdaq market site in New York City. I'm Brad Smith alongside Shauna Smith, and this is Yahoo Finance Live. Here is your morning rundown. 2 down, 1 to go. Ford's deal with the UAW heads to members for a final vote. After securing the support of union leaders on Sunday, President Shawn Fain called it a huge victory. It includes more than $8 billion in new plant investments and a 25% general raise over the 4-year contract. The union also reached a tentative deal with Stellantis, leaving GM, the lone automaker, left to secure an agreement.
And another packed week of earnings kicks off with McDonald's. Price increases boosted the fast food giant's third quarter results. We will get more insight into the consumer from the likes of Starbucks, Estee Lauder, and Mondelez later this week. Now, also in focus, the impact of weight loss drugs and how much drug maker Eli Lilly made from the wildly popular Manjaro.
And risk on. It's a crucial week for central bank policy around the world. The Federal Reserve's latest interest rate decision is due Wednesday. Investors are eager for any indication of a path forward. Have rates hit their peak is the big question. And when will policy start to ease? Another sub-big question. Also on the docket, decisions from the Bank of Japan and Bank of England. Oh, and U.S. jobs data on Friday, of course.
It certainly is a busy week ahead, but let's start with this morning's morning driver, and that is the UAW has record contracts in its sights from members at Ford and Stellantis plants, leaving GM as the final holdout. Now, the big winner out of this is, of course, those workers who fought for and won major wage increases and rolled back 15 years of concessions. And UAW President Shawn Fain, who brokered it all. We know Shawn Fain was quoted last week calling the contract with Ford a, quote, huge victory here for union workers. In terms of what is in this deal, and this is what's new out this morning, we're getting more details about this contract. It's 800 pages, and when it comes to what the summary is of what's included, 30% pay hike for full-time employees, $8.1 billion in manufacturing investments. When you take a look at where some of that money is going, $2.1 billion for an Ohio assembly plant for current products and also for a new electric van, $1.2 billion for a new EV plant in Louisville, Kentucky. We also have $1 billion towards a Kansas City assembly plant, and $900 million for F-150 production and a new electric truck. So this is being viewed by many here, at least on the union side of it, as a huge win for the union workers. They talked about some of the concessions that they were able to get from the auto workers. And of course, Brad, this then places even more pressure on GM to reach a deal and to reach it in a pretty timely fashion. Yeah,
you mentioned an Ohio assembly plant. I was in the great state of Ohio over the weekend, and there you hear boots on the ground about people who are noticing how much the cost of living has gone up, and cost of living a core part of where this negotiation went forward. This agreement would give and has given some of the Ford auto workers that increase over the life of the 4.5-year contract. About a 25% wage increase is what was targeted there. Also, the cost of living adjustment, that is going to be returning, plus some of the retirement and work-life balance improvements that they were looking for too, plus that ratification bonus here. So all of these things considered, some of that attention also shifting now in what Ford was able to do over to GM. And the way that GM was talking about this in recent weeks, especially last week when we think back to earnings and where they're going to be prioritizing some of what was put forward in Ford's deal and how perhaps they can leverage that in their own negotiations, but also their ambitions going forward. There's a lot of talk about where the electric vehicle component or ambitions will play into these negotiations and has played out in these negotiations. And then additionally, it comes back to still what's providing the most margins right now. Remember, GM talked about on their most recent car leading the industry in full-size pickup sales for 3 consecutive years and leading full-size SUVs for 50 years. So all of this considered, it's still going to come back to what's selling right now and on track to exit 2024 with fixed costs that are at about $2 billion lower of their increased depreciation and amortization. So all that to say, investors are going to be watching to make sure that those fixed costs, especially factoring in labor, factoring some of the expenses that are going to be added on now, netted out after these negotiations are finalized, that they don't skyrocket so much so to the point that it throws off the calculus around the valuation of these companies too.
Yeah, and I think that's a big worry here for analysts, at least going into this, just in terms of how much it's going to cost these automakers down the line. When you factor in the pay hikes, the increased benefits, everything that you just outlined, exactly what that means in the longer term is the big focus here for the street this morning.
Absolutely. Well, let's stay on the topic here. The United Auto Workers Union now has tentative deals with two of the big three automakers, and Ford and Stellantis are on the road to ratification while GM still in negotiations. Reports say CEO Mary Barra and UAW President Shawn Fain were in talks late into Sunday night. Let's break down the details of the two deals that are currently on the table with Yahoo Finance senior autos reporter Pras Subramanian. Pras, what's going on here?
Hey, Brett, how you doing, man? So good news here for Ford and Stellantis. Like you mentioned, a lot going on here, a lot of moving parts. But with Ford, at least the UAW's National Council approved a tentative deal with Ford. Apparently, there was loud cheering, and people were very, very excited and happy during this 4-hour meeting the UAW had with its members. Like you said, Shawn Fain saying that it was a major deal, historic deal. Among other things that you mentioned in terms of the wage increases was the $8.1 billion in new investments in battery plants or in new plants, battery EV plants now being part of the UAW master agreement, and of course the $5,000 ratification bonus, the COLA stuff. It's all big parts for these members who sort of lost a lot of these rights or these benefits when during the great financial crisis. So now the deal goes to the full membership for a vote in the coming weeks. Just turning to Stellantis quickly here, the automaker now, of course, has a tentative deal with the UAW. Same particulars in terms of wages on the same lines as the Ford deal, but we're also seeing that very important. They're reopening the Stellantis plant in Belvidere, Illinois. That was closed. That was a Jeep Cherokee plant they closed, and it was a big deal for Shawn Fain and others there because it meant to lay off about 2,000 workers. Now the plant will build a new mid-size pickup in addition to co-locating some sort of battery plant in the same facility, so a big win there. And finally, breaking this morning, Canada's Unifor and Stellantis reached a tentative deal as well, calling us, like they called us right last night at midnight, and just now this morning around 7:30 a.m. they were able to hammer out a deal.
Pras, when it comes to some of those sticking points, when we talk about GM, exactly what they're looking for, what the unions were looking for that GM hasn't been able to agree to, what are those main sticking points at this point in the negotiation process?
So the reports say that the sort of the wage and COLA and the wage progression stuff is sort of agreed upon. They've agreed with what Ford and Stellantis have sort of agreed to with the UAW. But the problem is that some of these retirement benefits and other sort of wage benefits are the issue with GM. GM has a lot of retirees from pre-2007. It's those benefits that's the problem, that they don't want to be exposed to higher and higher costs with regard to those workers. So that's a sticking point. And what happened this weekend, the UAW stepped up its strikes against GM, hitting its Spring Hill, Tennessee plant. This is the automaker's largest facility. They build stuff like the Cadillac XT5, the XT6, the Lyric EV, GMC Acadia, among other things, and engines for various Chevy and GMC and Cadillac trucks. So this was going to hurt them. I can't imagine GM holding out for too long here, given its rivals have already will soon be back to work, but there is no timetable yet for when a deal could be hammered out.
All right, we of course will be looking out for any developments on that. Pras, great stuff. Thanks so much. And we are going to be diving deeper into these deals and also the impact on the auto industry with Autolist Editor-in-Chief David Underkoffler. That's at 9:40 a.m. Eastern Time later on this hour, so stay tuned for that. Well, it's not often a Fed rate decision is just one of the big events of the week. Well, the FOMC unlikely to alter policy at its meeting on Wednesday, but it is likely to be overshadowed by the Treasury Department's fresh borrowing plans, which could impact an already volatile bond market. Earnings from Apple are the big corporate release of the week and will be viewed as a possible tailwind for stocks, with the S&P 500 now mired in a technical correction. Joining us now, we want to bring in Cameron Dawson, New Edge Wealth Chief Investment Officer. Cameron, lots to unpack here this morning, but let's start with where we start the week here. Just ahead of the trading day, we have the S&P entering correction territory last week. We also saw that from the Nasdaq. How does this set us up? And I guess, is this a signal maybe of more weakness that's still ahead?
Yeah, we did get oversold into the end of last week, so that does support some kind of bounce over the short term. We seem to be seeing that this morning, but I think that the challenge that we're in now, which is that we got oversold back in August, we got oversold back at the beginning of October, and each of the bounces that followed those conditions were pretty tepid. So what's resulted is that now we can see sort of a short-term pattern of lower highs and lower lows for this market. And it means that a lot of the areas that were support for the market, things that we hoped that the market would be able to bounce off of, have now somewhat become resistant. So a lot to go on this week. I think in the very near term, you are oversold enough to have some kind of relief rally, but then let's judge that relief rally to see if it sets us up for a move higher or if we'll continue in this downtrend.
Yeah, and this is typically the time of year where we get into that larger thinking, that question of will we see a Santa Claus rally come December? Is that off the table at this point in time from your perspective?
No, because seasonality is supportive at this point. But I think the important point here is that you'd be starting from a lower level. When a lot of people were hoping for a seasonal rally, you were at higher levels for the S&P, which had people projecting us getting back up to those July highs by the end of the year. Now that we're starting from a lower base, it just is a much higher bar to get you back up to those July levels. And yes, you could see a rally, but that doesn't necessarily mean that we go back to the kind of powerful up into the right market that we really had all from April through July until we entered this more volatile period.
Cameron, let's talk about the Treasury Department bond sale that's coming out here on Wednesday. Some out there on the street saying that it's actually a bigger event than the decision that we're going to get from the Fed on Wednesday. Just talk to us just about the significance of this and what the reaction could potentially be across the broader markets.
Certainly, it is very important because we think that we've been living in a world of big supply and demand factors for the bond market, which is why you have seen this lift higher in yields rather abruptly, meaning that you have seen increased supply, but the real key component here is that demand has been weaker for bonds. Part of that is the Fed itself. So we don't want to completely downplay the Fed's role in the lift in yields. The Fed has gone from being a huge buyer of bonds in the QE era to now being not buying bonds in the quantitative tightening era. They've had their balance sheet pulled down by nearly $1 trillion. That has contributed to this lift in yields. And so now we're in this scenario where we're really having to judge, will the Fed be willing to come in and buy bonds if economic weakness does materialize sometime in 2024? But until then, as the Treasury steps up supply, that means lower prices for bonds, higher yields in the short term.
Speaking of some of the Fed considerations and the calculus coming forward this week, what do you believe that they're going to be watching for, especially coming out of the jobs data on Friday, to really give them the inclination going into their November meeting about where that decision should rest, or at least where the tenor of the conversation should move forward, especially considering that we've been having the higher for longer considerations tossed about, or at least evaluated by the market right now?
Yeah, it is a really important point because if you go back to Powell's comments from a couple weeks ago, instead of talking about how tighter financial conditions, those higher bond yields could drive the market toward the economy to slow down because of that tightening in financial conditions. Instead, he focused on just how tight the labor market is and how strong demand is, and that could be the justification for them needing to do more. Our view has been that the Fed is going to be resistant to cut rates as long as the labor market remains tight, simply because they would be afraid that inflation could come back if they ease policy into a tight labor market and a tight economy. And so I think that the challenge that the Fed will have is that they have this tightening in financial conditions, and yet the near-term data, the current data, still says very strong economy, very tight labor market, which does not give them any wiggle room to ease policy or talk dovish.
So, Cameron, let's talk about what all this means then from an investment perspective. Certainly, people are out there trying to figure out how they should best position themselves for the remainder of the year, and then, of course, looking ahead to 2024. So what are some of the adjustments that you've made most recently as we have seen a bit more weakness creep into the market?
Certainly, we're finding opportunities in pockets of the market that have been getting sold off hard or really are trading at cheaper valuations. If you look at the equal weight S&P 500, in the near term, technically, it's in a downtrend. It's only about 5% off of its October lows. At the same time, it's only about one turn of multiple off of those October lows. That overall index is still struggling, but what I think it identifies is that there's a lot of great companies companies in there that are high quality, that have good balance sheets, strong free cash flow, that you can find that are trading at discounted multiples and are somewhat near their October lows. Then if we think overall, we have to remain very focused on quality in this market. We do think that we are late cycle, which just means that the balance sheet is incredibly important, meaning that we have to watch very closely about companies' interest costs, how much debt they have coming due, what they'll be rolling that debt over in this higher for longer environment, which means selectivity is highly, highly key, and really focusing on that balance sheet, I think, will be the big determinant between winners and losers in this environment.
Cameron, I know we've been talking end-of-year rally and Santa Claus rallies, but move over, Elf on the Shelf. I'm peeping the Ninja Turtles on the shelf behind you there. Shout out to that. Just giving me another idea for Halloween tomorrow. All right, so I'll have to figure out how to pull that off with some homemade pizzazz to it. Cameron Dawson, New Edge Wealth Chief Investment Officer. Thanks for taking the time.
Thank you so much.
Absolutely. Well, investors loving McDonald's earnings after price hikes helped boost the company's global same-store sales by nearly 9% in the third quarter, and revenue jumped 14% from last year. Yahoo Finance's Brooke DePalma has all the details on the Golden Arches. Brooke, what do we know?
Good morning, Brad. Well, on the call, CEO Chris Kamczynski, the call, which is still going on right now, said in difficult times, McDonald's continues to win as consumers look to the Golden Arches for value and convenience. And they aren't pushing back on those higher prices, which now are roughly up 10% for the full year here in the U.S. And as you can see here, despite these headwinds, the McDonald's brand continues to come out as a market share leader and affordability leader in the market, beating on both revenue and earnings per share. In addition to that, global sales, as you noted, jumped nearly 9%. That includes both company-owned and franchise-owned restaurants. And roughly, when you look at here in the U.S., sales certainly did benefit from those higher menu prices, in addition to new marketing campaigns like its in-featured meals that launched in August, in addition to growing digital and delivery order. Now, in addition to that, they did hold share among lower income consumers. They did say industry-wide, though, the traffic among those who make under $45,000 a year did slip slightly. But in international operating markets, especially in Germany, the company continues to increase same-store sales. Germany saw its 10th quarter of double-digit sales growth, and that was largely because of a value meal offering called the McSmart menu that trended well among consumers there.
Well, let's talk about some of the reasons that we did see an uptick here in sales, their digital business and also menu innovation. How big of a contributing factor was that this past quarter?
Yeah, well, digital sales is certainly building loyalty, which keeps consumers coming back. As you can see here in the quarter, digital sales made over $9 billion across its 6 biggest markets. That was higher than the previous quarter. It did make up about 40% of total sales. And they said on the call that it drives scale and loyalty that provides opportunities that other competitors can't match. And menu innovation, that McCrispy sandwich that we saw launched back in 2022 is now a $1 billion brand across multiple markets. In addition to that, last quarter, they did add the McCrispy Deluxe. And so as we continue to see innovation come out of McDonald's, they continue to trend well with consumers who are in a pinch during this difficult time.
Brooke, can you just listen out for any mentions of Grimace on this earnings call too? I imagine that there's going to be something about this purple taste bud. And I'm just hoping that for Halloween, a lot of people who perhaps do some makeshift paper mache outfits as Grimace, that they do so with a careful eye for, you know, how they represent the big purple fella or girl.
It's all about the boo buckets now, though.
The boo buckets?
The Halloween boo buckets, right, Brooke?
Halloween boo buckets did do well last year during this time. In addition to that adult Happy Meal that we saw launch in October of last year, no mention of Grimace yet. Of course, that was such a big highlight during the Q2 quarterly earnings call. But I do want to give investor a heads up. There is a investor meeting happening on December 6th, and they said they're going to give an insight into 2024. And so lots to look out for, but no mention on Grimace just yet.
Okay.
All right, we'll see if they say anything about boo buckets. But I guess that would be the current quarter. I know it's only in select locations this time around, but it was huge. It was a huge success, like Brooke was just saying last year. All right, Brooke, thanks so much. We've got just about 10 minutes here until the opening bell. Let's take a look at some of the action that we're seeing in the pre-market. Jared Blickery, what do you got for us?
I'll tell you what, we are starting the week on a little bit of an upbeat here. I think that will be a welcome surprise for investors who were just kind of beaten down last week. S&P 500 futures up about 65 basis points, 0.6%. Nasdaq 100 futures up a very similar amount. In the Dow, well, guess what? That's almost the same amount as well, 213 points there. And just thinking about the Treasury market, we have seen consolidation around the 5% level. We're still quite a bit below that. And I'm going to be doing a deep dive on the Treasury bond market, and we're going to find out some of those auction sizes this Wednesday. I have a deep dive on that coming in the next hour. But I just want to remind everybody, this is a tweet by Ryan Dietrich from last Friday. The average year for S&P 500 since 1950, that bottoms today. So seasonality perhaps giving a little bit of a tailwind. As I've been saying, though, if Treasury bond yields continue their march higher, probably not going to see any relief in equities. So a big caveat right there. What we're looking at here is the S&P 500 sector breakdown. This is what happened last week. Only utilities ended in the green. That is very defensive. And to the downside, energy ended up being the biggest loser, down 6% after some bad earnings, I believe, by Chevron Friday. Communication services also down 5%, and healthcare rounding out the underperformers. But I put on the pre-market prices today, and we can see consumer discretionary, that is retail, that's up 1%. And then communication services, one of the biggest losers last week, that is up 0.8%. Real estate, financials, materials, until proven otherwise, this feels like a kind of a dead cat bounce, but we'll have to see where we close today. Important not to get too faked out by pre-morning strength. Now, let's take a look at the Nasdaq 100 as well, and we can see a lot of green, not necessarily in the background. This is what happened last week in the big rectangles, but those little rectangles there, that's what's happening this week. So Apple up 22 basis points this morning, 1.21% for Amazon, Nvidia up 1%. So the mega caps, which really got drubbed last week, instead, except for Amazon and Microsoft, those are bouncing back a little today. And let's just look inside the tech market. Here's the semiconductors. We're seeing Nvidia up 0.9%. Taiwan Semi, which took a 5.8% drubbing last week, that's up 1%. And let me just skip over to the energy market, which was the worst performing sector last week. Looks like Chevron bouncing back a little. So kind of a theme here. It looks like things are just kind of bouncing back, guys, and we'll have to see what the morning comes.
Yes, as NERD would say, bouncing around, bouncing around, bouncing. We will see how things start off the day, at least for today. Final trading days of October here, we might add. Jared, stay with us for the opening bell. We've got much more. All your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Now let's take a look at some individual movers this morning. Shares of SoFi, they are on the rise after a strong earnings report boosted by student loan repayments. Wow, why did I say it like that? Student loan repayments, student loan volume for the quarter blew past expectations to pass $900 million, rising 133% sequentially as students prepared to start payments in October. Personal and home loans also beat estimates. The company also lifted its full guidance for the year. Stop laughing, Shona. All right, it's up by about 10% right now as shares are moving to the upside on this earnings report. One of the notes from the company, they said that they delivered another record quarter of financial results, generating 10th consecutive quarter of record adjusted net revenue, $531 million, and record new member additions of 717,000 as well.
Yeah, certainly. Well, going back, we're all a little tongue-tied. I'm the biggest offender of that. So I was laughing with you, not at you. But let's talk about what we're seeing from SoFi here for this most recent quarter, because in this release, like you were just saying, some other comments that we're getting on the earnings call this morning from their CEO, Anthony Noto, saying that the first 67% of the absolute growth in adjusted net revenue dollars was driven by the non-lending businesses, specifically technology platform and financial services segments. Also, their financial services segment achieving positive contribution profit for the first time, making all three reported segments profitable while bolstering consolidated profitability. So certainly a big report here from the company. We talk about the uptick, how much of a jump they saw in terms of revenue here for their most recent quarter because of the student loan originations, $919.3 million. That it was a massive beat when you take into account the street was only looking for $651.5 million. Some of the other numbers here standing out within this report. When you take a look at adjusted EBITDA, that was $98 million versus $44 million on just about a year ago, so about double that. And the membership count was up 47% on a year-over-year basis to 6.96 million. So you take a look at the stock reaction, obviously a good name here to track as we get into the trading day. You're looking at the pre-market action with the stock still off just about 0.4%.
Yeah, I think that should be the previous move, right? I think we were taking a look at some of that extended hours move earlier here as shares were jumping, but we're going to continue to watch this.
There you go. That makes a lot more sense with the extended hours move there, up just about just over 10% here.
Yeah, just one note on this too. The net interest margin, I think that's catching some investors' minds and eyes too. On a consolidated level, they saw sequential and year-over-year expansion in their net interest margin to 6%, roughly 5.99% to be exact there. Record sequential deposit growth of $2.9 billion there. So some huge figures, especially in the business of SoFi here, that investors have to look at. Year to date, the stock is up by about 49%.
Yeah, massive gains here since the start of the year. All right, let's talk about another mover that we are seeing. Well, at first, we want to promo something. Later on in the show, we're going to be talking a little bit more about SoFi's results here and the boost that they're seeing from student loan repayments. That's at 10:30 a.m. Eastern Time. We hear from Oppenheimer's senior analyst, Dominic Gabriel. All right, let's get to our next mover, and that's Broadcom's $61 billion deal to buy VMware, looking set to close, quote, soon. That's according to the companies. Now, it comes amid concerns that Chinese regulators could delay the transaction. In a statement today, the company is saying that there's, quote, no legal impediment here to closing under U.S. merger regulations. They did not, though, give an update on they did not give an update on their attempt to get approval in China. However, we know China is the big question here going forward, exactly what that looks like here. They didn't say how close they might be to getting any sort of approval there from Chinese regulators. That's the last major hurdle here to closing the deal. They did, though, reiterate maybe some optimistic toning here in this release. We know that the deadline here, it expires on November 26th. So we're certainly coming down to the wire. We've been waiting for some time for this deal to close. So I guess maybe a bit of an optimistic tone that we're hearing from both of those companies.
Yeah, it looks like about 10 different jurisdictions that they have approval from as of right now, and no legal impediments to closing under U.S. merger regulations here. But of course, notably, this is going to bring together two large companies, especially considering how they would be able to move forward in both of the ambitions, whether that be making sure that kind of within the consolidation efforts that they're moving forward with, being able to make sure that the semiconductor and infrastructure software solutions that Broadcom has, plus the and you love to hear me say this, the multi-cloud from VMware, those approaches and services that they have, how that all intertwines, kind of bringing together two different portfolio client bases and perhaps being able to cross-sell here. That's going to be significant. Before we get to the opening bell, though, we've got some big news breaking now, if confirmed. General Motors reaching a tentative agreement with the United Auto Workers Union to end a 6-week-old strike. That's according to reporting from Bloomberg News here this morning. We're tracking shares of GM here pre-market, as well as we're just seconds away from the opening bell here on this Monday. You're seeing shares higher by about 1.2% here and continuing to kind of not just track the move for GM, but also for some of the others that are looking across where they are able to strike deals and waiting for them to be ratified as well. Ford over the weekend, those discussions going late. And then additionally, here's Stellantis to the latest.
Yeah, and coming out of, let's dig a little bit deeper here into this report. It's out here from Bloomberg talking about what exactly this entails or what's included. The deal includes a 25% hourly pay raise plus cost of living allowances over more than a 4-year contract. This is according again to Bloomberg reports. GM's tentative agreement does have similar terms to what we heard here from Ford. Still unclear, though, exactly what the differences may be, but a story that we are going to track here into the open. Let's get over and talk a little bit more about some of the action that we're seeing here at the opening bell. Jared Blickery is still standing by for a look at what we're seeing across the globe. Jared?
Yes, we are seeing that bounce. Is it dead cat or otherwise? That is to be sorted out throughout the day and into the close. But we do have the Russell 2000 outperforming. Russell 2000 has just taken a shellacking. I'll chart it real quick. Year to date, it is now down 5.8%, a market departure from the Nasdaq, which is actually the laggard today, still up 21% on the year. But let's take a quick look at the bond market here. We do have Treasury yields inching up a little bit higher. Looks like we're down just a little bit. We're up on that, and this is the VIX that we're looking at. So the VIX has been actually hiding or holding around the 20 level, something to be interested in and keep in mind because we are coming from relatively depressed levels. So is this a new volatility regime? We'll have to see. Now, here is that 10-year T-note yield. There we go. Up 5 basis points to 4.89%. Again, doing a deeper dive into the Treasury market in the 10 a.m. hour. And here are the S&P 500 sectors. Everything green, a sea of green, which is a market departure from the sea of red that we had last week. Materials, utilities, financials, communication services, and industrials and real estate, all of those up more than 1% on the top line. So pretty broad swath there. And if I'm going to look into some of our leaders, we do see some red in some of the fringier parts of the market like meme stocks and actually chip stocks, which are really not fringy at all. Then we have solar in the lead. That's TAN up 3%, followed by Bitcoin. I hope we can get to that a little bit later. Korean stocks also bouncing back. I've talked about how Korea was leading the way down. Now we're going up. That is a start. That is a start going in the right direction. Here's the energy market also bouncing back from last week. The banking sector, another value sector, also bouncing back. So looks like we're dealing with quite a bit of green today, guys. Sending it back to you.
All right. Thanks so much. Well, we've got to track shares of smartphone giant Xiaomi. They are on the move this morning as well. It's the latest Chinese industry player to unveil a new operating system across its products. Tech companies have long sought to build customer loyalty with their own operating systems like Apple's iOS and Google's Android. U.S.-sanctioned Huawei also recently unveiled its own operating system. But here's some of the details about Xiaomi's. And for those of you who are tracking the stock here this morning, it's up by about 6%. Now that we got that out of the way. Hyper OS is what they described it as. This is particularly interesting as it's a combination, they're saying, basically of a custom Android system plus this IoT platform, Vela. Now, this touted Hyper OS as well, human-centric OS. I particularly don't know what a human-centric OS, just for full clarity, will look like, or how that's different from what I've got in the palm of my hands for most of the day here. That aside here, they're saying that it's essentially one single operating system for centralized and easier management. And it's a larger question for within the larger kind of competitive realm that we're seeing as IDC had tracked over the course of this year, Apple on pace to make sure that it was getting towards its largest market share at about 19.9% by by the end of 2023 of OS users on that iPhone or the Apple OS. This is particularly interesting because for Xiaomi, if this is successful, it would allow them to cut into some of those existing operating systems out there, such as Android and such as what we had seen already from Huawei as well.
Yeah, certainly. I think that just in terms of the implications of this, why it's so significant is just the opportunity, right? In terms of the addressable market out there, how big, how popular this could potentially get, and also just how sophisticated this operating system potentially is. You talk about the fact, obviously, we have the U.S. sanctioned Huawei Technologies trying to work towards more integration when it comes to OS completely here from Google's Android. So talking about the opportunity here, exactly what that looks like, and also just the timeline of this. They're saying that the Hyper OS is going to come pre-installed on the latest Xiaomi 14 smartphone series, as well as some of the devices launched in their mainland Chinese market, like smartwatches and TVs. In terms of what it looks like beyond that, we're still getting some details on that. It's going to be a rollout here across other products as well. But at least in terms of what we're seeing at first, it's going to be available in the Xiaomi 14 smartphone series. So we'll see.
It's all about that ecosystem.
It is. All right, let's talk about another big mover, and that is Meta, the social media company on the move this morning after launching a paid ad-free subscription tier to Facebook and to Instagram in the EU. The service will be offered for around $13 on phone apps, $10 for the web platform. Now, the tier is meant to address concerns around Meta's ad targeting and also data collection practices. We talked about the fact of when this was reportedly going to be the case. So now officially Meta coming out and saying that they are doing this. They're doing it because of the crackdown that we saw in the EU over user privacy data and exactly what needs to happen from these social media giants to better protect their user data. It's very important to point out that Meta is going to continue to offer those ad-supported services in these markets without an additional charge. You'll just have to opt in for that. In terms of how many people are going to be subscribing to these ad-free subscriptions, I don't know about that. I mean, that's a heck of a lot of money on a monthly basis in order to avoid ads and not share your data. But we know many users are extremely concerned about the access that some of these social media giants have to their data. So maybe this is a smart move from Meta. I think it is.
This is going to be a major shift that Meta has to be able to prove to millions, billions of users who have come accustomed to a free platform, a free experience where they can go into this, and dare I'll say it, a metaverse, if you will, because why? It's a universe that's on top of what you're already living in within your normal realm. So all of that considered here, what they've been able to offer for so long for free, because advertisers have essentially subsidized the ability through large multi-billion-dollar ad campaigns in some cases, in the ability for end users to become accustomed to a free platform and perhaps, buy in or transact on the marketplace or on Instagram, for instance, just have to get served up a few ads from influencers or other companies who had started running ads. At the end of the day, for those end users, they're going to have to see something that is valuable enough for them, or at least on the other side of that frame of mind too, something that is so annoying in the amount of ads that you see that you say, I've got to make it stop. And that's the other side of it. Are you just going to annoy people out of the experience? Or are you going to annoy them so much so that they say, well, there's value in the platform and me still being there and having a presence here, but I don't want to see all these ads, so I'll just pay to not see them.
Yeah, but you also have to take into account what this means for Meta's revenue, right? When we come to find how this is a major revenue source here for the company, if they lose the ability then to personalize the ads, they're not able to best target some of their users unless they're opting in for the ad portion of this. It could have real financial implications when you talk about the potential here for this to expand and what that crackdown looks like across the world.
Well, because of the iOS changes as well, they've already lost out on certain data points that they can advertise based on top of, so they're not able to create that same indexing that they were able to provide to so many of the marketers, the advertisers that were coming to them for that granularity that they could get. So now, what's the other side of that? Okay, well, we've got to offset what we're losing in some of those advertising campaigns by making sure that it's being paid, or at least the experience is being paid for by some of the other users that are on the platform, whatever percentage of it, because I imagine they've run the calculus before launching something like that, as any business does. But in that effort, I think making sure that that offsets enough not to deter people from wanting to continue to come back, and advertisers recognizing that there's enough of a pool of clients that they could potentially market to.
Yeah, well, EU users now, when it comes to Meta and Facebook, they have the option here, an ad-free version or an ad-supported version as well, which of course would be free. All right, we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. '23 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation,
Mortgage rates.
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance. After 6 weeks of targeted striking, the United Auto Workers Union has now reportedly reached deals with all three big automakers. That's according to a Bloomberg report. Now, GM's tentative deal just came through. Ford, Stellantis, and now GM have all agreed to offer workers a 25% wage bump, cost of living adjustments, 3-year wage progressions, and more. Joining us now, we want to bring in David Underkoffler, Autolist Editor-in-Chief. David, it's good to see you here. So breaking earlier this hour, we just got a deal reportedly that the UAW was able to reach with GM. What's your first take just on some of the concessions that the automakers were able to give here in order to reach a deal with the union?
Yeah, good morning, guys. Really not a surprise that they were able to pull together a deal with General Motors. You've got the contours of the deal with Ford and Stellantis, so it was really pretty expected that this would happen pretty soon. And some big gains here for UAW members. You're looking at wage growth, like you said. You're also looking at cost of living adjustments throughout the duration of this contract. That was a big win. You're looking at pension increases, contributions there. And you're also looking at, like you said, wage tiers, getting to the highest tier quicker for new workers. And then also sort of reducing the dependency on temporary workers. That was a big sticking point, too, particularly with Stellantis. UAW felt like they were relying too much on temporary workers. So they sort of worked out that to get temporary workers to full-time status much quicker.
So we had been hearing just in recent weeks, especially from GM, about the losses that these companies were seeing because of the strikes. And so this stops the bleeding there. But what have we seen ultimately from the expenses that are going to be coming forward that perhaps change some of the calculus around how each of the executives at these automakers now need to think about the types of vehicles that they're producing, where they're prioritizing margins and their takes on a per vehicle unit basis, and then additionally the total headcount that they need to make that happen?
Yeah, so like you said, first thing, the automakers were losing a lot of money. I think General Motors said last week, all told, this is about $400 million a week that they were losing. And Ford and Stellantis certainly losing, many hundreds of millions as well. Moving forward, there's significant investments here for the big three. You're going to see primarily it's the future of EVs, right? This is sort of the existential risk to the UAW. As we all know, EVs are simpler to make. They take fewer people to assemble them. So as many gains as UAW was looking to get in this contract in terms of near-term kind of economic, dollars on the table, they were also looking for longer term. Can we make sure that our members have a seat at the table? For the, as EVs become mainstream and they become sort of the primary type of vehicle they're building. So you're seeing things like a big concession with General Motors that they gave the UAW was any joint venture battery plant would fall under the UAW contract. Ford and Stellantis existing plants that they're already building. There's this big Blue Oval City battery plant in Tennessee that Ford is building that now falls under the UAW contract. So you're seeing pretty big wins in terms of allowing UAW members to know that yes, they've got concessions in the near term, but as these EVs become mainstream, that they're going to be the ones assembling them, and so that gives you sort of long-term wins for the UAW.
When we talk about some of those long-term wins, obviously Sean Fain looked at as a winner in all this. When we talk about some of the momentum now that the UAW has, are they going to be looking to target other automakers that aren't currently unionized and try to unionize those workers right now because of this momentum? And who would that be?
Yeah, for sure. You're going to see this is the wind at the backs of both Sean Fain and the UAW. I would absolutely expect that. There's sort of the point here of, yes, this may have raised labor costs for the big three, but there's also the potential opportunity for the UAW to take this. They could go to Tesla, they could go to Toyota, Honda, Hyundai, Kia, brands that have manufacturing footprint in the U.S., but they're non-union shops. And they can take these wins and say, and whether these are plants that they've already tried to unionize and failed, or they haven't even tried at all, they can take these wins to those plants and see what, how the membership or how the employees of those plants feel. I mean, Sean Fain said during these negotiations that he didn't see the employees of those rival automakers as rivals themselves. He saw them as future members. So I would imagine they're going to feel pretty confident, and you're going to see some big gains. Tesla's another one. I would bet that that's probably at the top of UAW's list to try this again.
Yeah, I was just taking a look at Tesla stock here this morning. It seems like shares are still up by about 0.7%, but perhaps it gives even executives there a look at what if they were able to, or if they were coming in closer relationship at some point with the UAW, what could appeal to and appease perhaps some of the desires there here. David Underkoffler, Autolist Editor-in-Chief. David, also always appreciate the time and insights here.
Thank you, guys.
Thanks. All your markets action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Price hikes did not deter customers from grabbing their Happy Meals last quarter. McDonald's saw global same-store sales jump by nearly 9% in Q3, with digital making up 40% of its total sales. CEO Chris Kempczinski told investors the macroeconomic environment is unfolding in line with our expectations for the year, and we continue to deliver convenience and value for our customers, end quote. Peter Saleh, who is the BTIG Managing Director and Restaurant Analyst, joins us now. Chris, thanks for taking the time here. Peter, excuse me, getting names mixed up here. Just excited about what Chris Kempczinski is saying on this call. My goodness, the Golden Arches. So ultimately here, broad strokes, your takeaway from this quarter and how it is mirroring with what we're seeing on the macro as the CEO was talking about.
Yeah, great. So thanks for having me on and good morning. So look, I think McDonald's had a good quarter, but definitely weaker than they've had in the past several quarters or year. I think the couple takeaways from the call was they, in their prepared remarks, management talked a lot about macroeconomic headwinds. They talked a lot more about value and the importance of value. And you can see that as they start to pivot to more value offerings, more value bundles, not just here in the U.S., but on a global basis. So clearly something is shifting. Traffic in the U.S. turned negative. Their comps were all boosted by menu pricing and the average check, but there is definitely a shift in the consumer in the U.S. That is happening, and they're responding with more of a value offering going forward.
So, Peter, what does that mean then for results, do you think, the current quarter and then looking out to 2024?
Yeah, look, so I think they'll be able to win and take share. I think the entire industry is pushing more on value, but it's just going to be more competitive. You're just going to have to you're going to have to drive more transactions with a lower check. Maybe you give up a little bit of margin to do that. That is yet to be determined how deep the discounts are. Keep in mind, McDonald's has been discounting for a significant amount of time now, for maybe a year or so, but really through the app. So you can get a 20% off your entire order if you go through the app. So the discounts are available. I just think the level of advertising behind them is really going to start to kick up in the next couple of months into the early part of next year.
And that advertising is where we've seen them lean into nostalgia, cough, cough, grimace. But at the end of the day here, too, it does come back to this kind of this expectation that we've seen from the economy going back into and going rather forward, I should say, into 2024. We've been discussing with analysts and economists about their expectations for any type of shallow, mild, or even more deep recession. Is recession good for burger sales at McDonald's?
Look, I don't think recession is good for anybody in this space. I think the one thing that this space has a strong correlation with is job growth and income growth. And we're still getting a lot of job growth and income growth. So, look, they had healthy same-store sales in the U.S. Traffic was negative. As long as we continue to create jobs, I think they'll hold up just fine. But keep in mind that the weakness this quarter was really related to that lower income consumer, making $45,000 or less per year. They called that out. That was a little bit of a shift. So we got to keep an eye on that lower income consumer. We got to keep an eye on job growth. Job growth remains healthy. The lower income consumer is obviously feeling some pressure with inflation.
Peter, when it comes to the biggest challenge, obviously outside the slowing macroeconomic conditions, when it comes to McDonald's, how that positions them amongst rivals, what else is on your radar that maybe the street or other investors aren't thinking of when it comes to McDonald's and the plans that they have ahead here in the coming months?
So I think McDonald's always finds a way to take share because they've got better assets, more modernized assets. If you look at their base, they made investments in their restaurants in terms of modernizing them, bring them up to date in 2018, 2019, 2020. They really spent billions of dollars to get there, where many of their peers weren't able or couldn't do it. So I think that's what really differentiates them is the modernized restaurant portfolio here in the U.S. and really across the globe. But also their advertising budget is far larger than anybody else's. So they tend to lean on both of those in these types of times to really drive market share gain. So I think they'll gain market share, although it might be at a slower pace than what we've seen in the past couple of years.
All right, Peter Sala, great to get your insight. Always appreciate you taking the time. BTIG Managing Director and Restaurant Analyst. Thanks, Peter.
Thank you.
We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
that eat up your storage, you can thank the cloud for that. No, there aren't actually vast data centers hovering in the sky. It's a physical data center that could be thousands of miles away from you.
And when you think about the billions of people streaming videos, using the internet, even using ChatGPT, all of that space starts to get scarce. And that's why some engineers say we may have to turn to the ocean to store and process our data in the future.
Companies like Microsoft are already working on testing a data center that lives completely underwater.
Back in 2018, Microsoft sank a data center off the coast of Scotland in a first-of-its-kind experiment.
That underwater data center was equal to 864 servers and 27.6 million gigabytes. That's enough storage for nearly 5 million movies and as powerful as several thousand consumer PCs. It also cost Microsoft about $25 million.
But let's back up a minute. What exactly is a data center? It's a physical facility that stores any company's digital data.
It's full of IT capacity, networking, processing power, and storage. And that's what our digital economy and our digital lives, are really heavily rely on.
You've heard of the big tech data centers, Amazon Web Services, Microsoft Azure, Google Cloud. Those live above ground across the US and around the world. Their growth and usage has exploded over the past decade.
Along with taking up space, data centers also take up an extreme amount of energy. Research shows data center energy usage has grown roughly 25% a year on average since 2015.
An underwater data center is similar to a land deployed data center, yet it has specific requirements. So, such as it needs to withstand the water from the outside. So it needs to be a sealed environment. It has to have some sort of connection to shore in terms of providing the power as well as the network. And that, is, it's not a trivial task.
The goal eventually is to use renewable energy, like offshore wind farms, to power these data centers.
And the water could just inherently require less energy, a lot of which is used to keep equipment cool. Underwater data centers can use the water's naturally cooler temperatures to prevent overheating.
Increased workloads, specifically, for example, around artificial intelligence, requires different heat removal strategies and liquid cooling in its different forms as it comes in, is a good example as to how we can more effectively reduce this heat.
Microsoft's experiment took years to complete, and it worked. Now other companies are looking at the benefits of data centers underwater.
This is especially crucial following the AI boom, which will cause even more storage needs, requiring more and more data. The big question for tech companies, the money. Right now, some estimates show underwater data centers cost about as much as above ground ones.
It is very challenging for me to believe that a underwater deployed data center could be as cost effective.
But experts say something needs to be done.
Just like you said, Inez, something needs to be done here, and that's exactly what we're going to be talking about today. And the barriers might be high, but one company is leading the charge. So joining us to discuss what's next for underwater data centers is Maxie Reynolds. She's the CEO of Subsea Cloud. That company builds underwater data center pods within 12 weeks, and they can be deployed in our oceans for storage. So Maxie, thank you so much for joining us. Obviously, this technology is very new. So start us off with your 60-second quick take about how your technology works.
Yeah, okay, thanks for having me. So what's sort of interesting is that it's not actually that new. We have had compute power underwater for give or take 50 years now. The fuel that we get that goes in our cars, that's in our houses, is typically fossil fuel. And so, pipelines, other subsea assets require compute. So our application is fairly new in terms of we're putting, megawatts down into the water, but in and of itself, it's not really that new. But what we actually do is we build, deploy, and maintain these data centers for economic and sort of environmental benefits, and it's fairly cost effective in the way that we are doing it.
And Maxi, Ines here. So you talk about environmental benefits. Talk to us a little bit about that. What is the biggest problem that Subsea aims to undertake here? And why should companies be considering underwater data centers?
Yeah, okay. So by placing them underwater, you eliminate the electrically driven cooling. And so we see about a 40% reduction in the power that's consumed, and so a 40% decrease in the carbon emissions. About, every megawatt hour that we consume creates about half a ton of carbon. So when you put a data center underwater, you reduce that carbon by about 900 tons per unit. So it's sort of interesting to look at it that way from a climate perspective.
Right.
And why companies? Oh, sorry. Go ahead.
Sorry, Maxi, to cut you off. I just wanted to say it sounds like there's a reduction in carbon usage, but there's also a reduction in cost. You say that reduction is about 70%, but some of our sources have said that it's kind of a wash because it's expensive to, say, send someone down to the bottom of the ocean if you need to fix one of these things. How do you justify the wash on cost savings?
So there are actually cost reductions over both the OPEX and the CAPEX. So starting with the OPEX, there are no costs for cooling, right? So that's a big one. And then in terms of maintenance, your maintenance cycle basically is elongated. You have to do less to the servers less often because there's no dust, there's no debris, there's no people jostling the cables, things like that. Those are really the biggest factors in determining when a data center goes down or a server goes down within a data center. So we see that. And then we would never send actual people to do this. So we don't rely on divers. We actually use ROVs, remotely operated vehicles, and they're very cost effective. The biggest cost that we face that you obviously do not face on land is the vessel cost. So what we do there, again, to sort of try and be smart economically, is to take vessels on what are called interruptible contracts. So they're within a sailing radius to a cluster of these units that we place down. And what happens is we say, hey, we need you. We have this maintenance window. They will stop the job, pause the job that they're on, come to us. And we keep those costs down by employing that method.
Maxi, we talked earlier about Microsoft and its test in 2018, but are other companies doing this? Are you working with other companies? Give us a little bit of the landscape of where this sits now, and do you see a future where big tech has underwater data centers?
I do. So let's sort of back into this. I absolutely see that as the future. I don't see it as the only method in the future, nor should it be. We should simply move towards immersion cooling, whether that is underwater or not. I think algorithmically, we are probably going to see a bit of an upsurge in data centers underwater because of latency, which is maybe too down in the weeds for this, but ultimately it's required if we're going to use AI at speed and for other things like high frequency trading, things like that. So yes, it will happen. Microsoft, I think you said at the top of this that they were about $25 million for their initial test over in Scotland. And there's a few reasons for that. One, it was a test, so there's no economies of scale. But the other thing is that there are two ways to allow something to incur the pressure of water. You can make the walls very thick, or you can compensate it from the inside. Microsoft and another company called Highlander, which are Chinese, they make the walls very thick, but there's a sort of skew in this space server coefficient when you do that, because you have to make the walls very thick the deeper you put it into water. Basically for us, we can deploy at 10 feet or 9,000 feet, although 9,000 feet is a little bit of a flex because there's really nothing down there, but we could, with really little to no technical calculation, varying at those depths. So it's sort of interesting how you get things underwater. You kind of have to be a subsea engineer to really know how to do it effectively. And that's sort of what's missing from an analyst's viewpoint.
Really helpful overview, Maxi. Next time we have you on, I want to talk to you about your ethical hacking background. So we'll bring you back for that. Thank you so much, Maxi Reynolds,
Thank you. Thanks a
Subsea
lot.
CEO. We really appreciate it. So regardless of where the data storage is happening here, it's clear that the overall industry is having a moment. Allied Market Research projects that the global data center automation market is going to reach $32.5 billion by 2030, and that is, of course, thanks to the AI boom. So we want to talk about how investors should be preparing for this expansion. Here to discuss is Anurag Rana, Bloomberg Intelligence senior analyst. He covers software services and cloud providers extensively. And we're also joined by Charles Myers. He's the CEO of Equinix. And thank you both so much for coming on. Charles, I want to start with you. It's really wonderful to have you because Equinix is one of the world's largest digital data center firms. It's clear that reliance is expanding exponentially, and thanks, of course, to that AI boom that we've been talking about. But high demand can be challenging to reach when it's coming at you at such a fast pace. What would you say is the single biggest thing that your firm is doing to prepare to meet this boom in demand?
Well, I mean, I think we're working with our customers to really understand how their needs are evolving and adapting, and we have the benefit of really, as one of the larger scale players around the world, of having a data center footprint that's highly distributed in 70 markets around the world. And we're really working with our supply chain to ensure that we can provide the, the capacity that people need, as they're really, AI is, I think, just another catalyst in what has been a significant multi-year boom in the demand for digital infrastructure. And so for us, I think it's working with our supply chain to ensure that we can put the right capacity in the right places for our customers to meet their demand.
And that surge in demand is great, but it also comes at a cost for companies. Anurag, I wanted to ask you from an analyst perspective, you're thinking when you see headlines of, for example, Microsoft investing millions in a test for these underwater data centers, should investors be concerned about the amount of capital that is required for green energy, so to speak, data centers going forward?
Yeah, no, that's a very small amount in our view. At any given time, AWS is going to spend, let's say, north of $30 billion a year to expand their data center footwork over the next couple of years, let's say, at the least, I would say. Same number for about Microsoft also. So these things are important because as the AI workloads increase, the need for power increases, the need for renewable energy increases. There is so much that needs to be done to make sure that these data centers are far more efficient than before, because I think that's going to be a big cost for these companies, both in the short and the long run.
So as Anurag was just saying, Charles, I want to get your take on that potential solution. I'm not going to ask you directly about your competitor, Microsoft, here, but how would you grade an underwater data center solution? What letter grade would you give to that?
Well, to be clear, Microsoft, we definitely do not view them here as a competitor in this space, very much as a partner. In fact, we play a significant role as large scale players like Microsoft, AWS, Google, et cetera, are architecting their data center footprints around the world, and we play an important part in that. On the topic of subsea, I think it's very difficult. I would say it's too early to tell grade. I think that it will potentially have applications, I think, over time. In the previous segment, the CEO of that company was talking about the need for distributed infrastructure, that's something that these smaller scale data centers distributed around the world might be able to do in subsea and underwater environments. And I do think there is a need for distributed infrastructure, but as she said also, I think there's a lot of different solutions. And as Anurag just mentioned, the large players are spending massive amounts of money on data centers, ourselves included, and I think they're investing in a variety of technologies that are going to make those substantially more efficient and more scaled. And more traditional technologies, although somewhat early themselves, like liquid cooling to a chip at the chip level or via rear door heat exchangers, those types of things are, I think, going to be much more cost effective in the near term.
And Charles, going off of that, so do you think, some of the solutions? If it's not subsea, what are some of the more promising ways of conserving energy, of providing green energy for data centers going forward?
Yeah, I mean, it's about a number of things. I think power availability, about efficiency, et cetera. And so there's a number of techniques that I think we and others are using to improve the efficiencies of data centers in terms of how they're powered, how they're cooled. Liquid cooling is, I think, going to be a prominent example of the technology that will reduce the costs associated with, traditional air cooling in data centers and make them substantially more efficient. And then I think using, green sources of energy, that are not necessarily only renewable, but renewable sources as well as some non-renewable sources that are still very carbon friendly, and those could include over time, I think, a variety of technologies. For example, I think on-site power generation is likely to be a part of the equation as the data center demand continues to press on the grids. And so I think you're looking at things like small scale nuclear potentially being answers, partial answers to this problem over time.
So Anurag, final minute for us here. How do investors play this space? I know you cover the cloud providers specifically, but any other plays here?
Yeah, I think, frankly speaking, they are the ones who are really one of the biggest beneficiary, as are the co-location facilities like Equinix, because one of the biggest things we'll see is more shift from on-premise to the cloud over the next decade. Even now, after being talking about cloud for almost 20 years, only a small fraction of the workloads are currently on public cloud or even outside their current corporate data centers. But there is no logical reason, in our view, why a company should, own and maintain their own data centers.
All right, Charles, I can't let you go without asking you about Fed Week. So what's keeping you up more at night these days? The moves of Jay Powell or these energy prices?
Well, probably a little bit of both for sure. I think interest rates continue to be a bit of a drag on any industry that's capitally intensive, right? And so, but I think we're going to see stabilization there over time, and so we're really focused on this demand opportunity and the energy part of that. But I think both of those things over time, I think, are going to be very solvable. And I think the biggest driver right now is just a huge wave of demand that started with cloud. Was sort of the COVID lit the match on that, and now AI is fuel on the flames. I think of demand overall for digital infrastructure.
All right, thank you so much for that, Charles. Really appreciate it. We've got Anurag Rana, Bloomberg Intelligence Analyst. Anurag, always great to speak with you, and Charles Myers, CEO of Equinix. Thank you both so much.
Thanks for having us.
Thank you.
We're going to have all of your markets action coverage ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Welcome back to Yahoo Finance Live, everyone. We can expect some big bond market moves this week, and it won't be just because of the Fed. The Treasury Department's new borrowing plan that will be out just hours ahead of the interest rate decision. Here to break down what we can expect is our very own Jared Blickery. Hey, Jared.
Hey guys, let's take a look at this. These are some big numbers, and you're right. It's not only the Federal Reserve that's going to be in focus this Wednesday at 8:30 a.m. The Treasury Borrowing Action Committee, they're going to announce a quarterly refunding statement for the Treasury with their input. And this is what we're expecting next week, $114 billion in Treasury bonds and notes on supply. And this is a market increase from the prior quarter in August that was announced for the upcoming months, which was $102 billion. Now, there are lots of reasons for these increases. We're not going to deal with what the federal government is spending here. What I want people to take away, this is a Treasury supply chart going all the way back to the beginning of January of last year, of 2022. Here's where we are right now, and we are expecting the Treasury supply to increase over the coming quarters throughout the next year. And that's a very important distinction because previously we had seen it dropping quite precipitously into earlier this year. And that has to do with the debt ceiling and all kinds of other wonky market stuff. A couple of things that affect Treasury supply. The Federal Reserve has its ongoing balance sheet reduction program going on. They're at about $8 trillion right now. That is a huge amount, but suffice to say that rather than accumulating bonds like in QE, with QT, the Federal Reserve is decreasing its balance sheet. And it could be that some of this expected supply actually manifests itself in Treasury bills. The Treasury has been selling short-dated bills because it's easier for them to be absorbed into the market. So that's another hiccup here. But in terms of the interest rate, and that's really what this gets at, the more supply there is in the market, the lower bond prices go. And because bonds and yields are inversely correlated, that means yields are shooting up. And that's why we're seeing the 10-year at 4.89%. Now, it's important to say that the Federal Reserve, Jerome Powell, based on his recent comments, does not believe that this is because inflation expectations are higher. He thinks it's endemic to the bond market, something called the term premium. And that has to do with the amount of risk that's held by an investor that's not otherwise described by, for instance, Fed monetary policy or inflation expectations. And then I'll end with this. There's one more monkey in the wrench, and that could be Japan. We have Japan's 10-year yields close to 1% now. That is the highest in decades. And we know that the Japanese investor, they like to save in bonds. So as the Japanese market becomes more competitive with the U.S. in terms of yields, that's also going to mean less Treasury supply. So we know that China hasn't been buying as much. The Fed isn't buying. Potentially, Japan is a competitor for the Treasury bond market. All of this put together means that we don't have a lot of certainty in the Treasury market right now. And that spills over into equities, which is why we're seeing a lot of this weakness.
Certainly does. A massive driver in equities as of late. All right, Jared, great stuff. Thanks. Well, shares of Sanofi moving higher this morning after a major sell-off on Friday. The stock crashed almost 20% after the drug maker missed Wall Street's third quarter expectations and also announced a plan to spin off its consumer health division. Here with the latest on that, we want to bring in Yahoo Finance senior health reporter Anjali Khemlani. Anj.
That's right, Shauna. Obviously, the news of this consumer spinoff really overshadowing the results of Q3. But that consumer spinoff is something that Sanofi kind of dropped on investors. We're seeing a little bit of that movement in the stock today after, of course, that 20% plunge. And it could mean that, investors are still sort of digesting this news. They lost about $21 billion in market value. And the why now question seems to be permeating. CEO Paul Hudson said in the release that they're looking at patent cliffs for some of their products in the mid to early 2030s. And that is why he said, quote, "We are deepening our investment in R&D, taking steps to becoming a pure play biopharma company and further optimizing our cost structure." This is set to take place at the end of 2024, so it would be lowering the guidance for 2025. And that's the outlook that really impacted the company's stock Friday. It's important to note, though, that this is not necessarily new. We have seen other large pharma companies spin off their consumer segments in the last several years, Novartis, notably with Sandoz, GSK with Pfizer, with Haleon, and then Johnson, of course, the latest one with Kenvue, which we know is basically the largest consumer unit that has been spun off recently. And we saw those results recently. So not shocking. It has been sort of a trend in the industry as these companies look to run tighter, more efficiently, and more innovatively. And so we'll wait to see if it in fact does pay off for Sanofi as well as the others.
All right, well, indeed, shares up by about 3% here on the day. Thanks to our own Anjali Kamlani for breaking all that down. Appreciate it, Anj. We've got all your markets action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Live from the Nasdaq market site in New York City, digital financial services company SoFi is in focus this morning. And it's fair to say that the analyst community is still fairly split over this business. It's been a good year for shares, but the bear case for many has been based on the idea that the stock is overvalued. This morning will go some way to dispelling those concerns. Shares rocketing after a strong earnings report, boosted by the resumption of student loan repayments. Volume for the quarter blew past expectations to pass $900 million. And the company also lifted its full year guidance for the year. Joining us now to break it all down, we've got Dominic Gabrielli, who is the Oppenheimer Executive Director of FinTech and Specialty Research here. Dominic, great to have you here with us this morning. You think about the reaction that shares are seeing and what ultimately SoFi had to say in this earnings. Why do you believe that we're seeing the reaction that we are here in Wall Street?
Sure, and thank you so much for having me. I think part of what you're seeing, the outperformance and the stock being up today, is revenue growth was a little bit better, about 15 million better than our expectation. And you've also got a lot of that, about 12 million of it, of that beat falling to the bottom line in adjusted EBITDA. And so look, the adjusted EBITDA incremental margins are significantly better than their 30% long-term guidance. They have about 48% incremental adjusted EBITDA expected this year margins. And so that's really, really strong. And so look, SoFi continues to have a really diversified business. The businesses are starting to chug along on multiple fronts in the financial segment and the tech segment. It's starting to come back towards some of the underlying growth rates we were expecting. And so there's a lot to like in the quarter for sure, as well as student loans being up, originations being up over 100%. And that was actually much faster than we were expecting. We thought maybe in the fourth quarter, a lot of these loans would come back after the moratorium had ended. But that was a surprise to us for it to come so quickly already in the third quarter.
So then, Dominic, what do you think then the trend or that rate looks like in the current quarter? Because we know obviously it did benefit last quarter. When it comes to how big of a benefit of the resumption of student loan payments and the originations is going to be this quarter, what are your expectations there?
Look, I think we still have some really low comps where we were basically just SoFi was effectively just originating private student loans, refinancings, and now we have the federal refinancings coming back. And so we expect, 130% growth. It's an astonishing number, but that just goes to show how much the moratorium really affected them. And the demand for people to really term out these loans. They're not getting necessarily a significantly better rate given where rates have already risen from Fed actions. But a lot of people are extending the loan terms to lower those monthly payments, make them more affordable. That's what we're seeing.
All of these things considered, if there's one thing that you need to hear from SoFi execs about some of that long lead and some of the longer term expectations that even those who are continuing to watch this company like yourself have, and whether or not they're measuring up to and meeting some of those targets, what would it be? What is that core catalyst that really needs to be unlocked for this company?
I think continued profitability improvement and strong capital levels and a strong funding base. I think all these various factors really will affect the stock. And they started selling loans again, which is really important. This is originally an origination business. And so getting back to a good combination of origination and holding some loans on the balance sheet is really going to benefit this company in terms of how investors view the story, view the accounting, all those factors. But that's continued 30% incremental adjusted EBITDA margin improvement. That's holding up and actually better this year. They're expecting that again next year, roughly 30%. So all these factors come into play, and we kind of like what we're seeing right now, especially after this quarter.
So you like what you're seeing right now was a solid quarter here from the company. We're seeing that reaction in the market today. When it comes to whether or not this momentum is going to stick, not only in this current quarter, but looking ahead to 2024, how do you see that playing out?
Yeah, it's a fantastic question. Look, I think that we're going to have a really great entry point into this stock. I always talk about a level below $7.50, even $6 being a really great entry point for this stock, given the valuation and what is expected the long-term valuation to be based on, whether it's book value, whether it's revenue growth. All these things really matter for the combined valuation of the company. And so I think we're going to have a really excellent buying opportunity in 2024, but I think the trends will probably slow down a little bit. So if on the question I had on the call, I actually could see this business accelerating as others pull back, but SoFi is going to likely be pretty cautious as well and not try to take too much market share and ramping up revenue while others are pulling back. They have their own credit book, obviously, and the people that they sell to. The loans need to perform in a certain way. And so for the buyers to keep coming back. So it's really important that, SoFi takes a measured approach. We expect revenue growth to slow next year from this year, but still high 20s growth rate in revenue. And so, all these things put together, effectively what we're looking for is for a dip in the stock. And I think, the long-term trajectory is going to be on the right path.
This is also a company that's been talking about all ambitions all in one app and really trying to bring together kind of a financial services ecosystem or one-stop shop approach to its end users here. What components do you think they still need to add on that would really round out everything from student loans to financing on, other parts of your life to make sure that consumers are feeling that or at least gravitating towards that offering?
It's another really great question. They really do have quite a significant amount of products that consumers are going to be looking for. Now, one thing that they could dive into more in a more meaningful way could be something along wealth management. They have some, wealth management products, stock trading, but they just recently had 3 different IPOs that they allowed retail investors to join. That's a new thing. But overall wealth management, because remember, their base, unlike a lot of other, SPAC companies that came out in the last 2 years, this customer base is really high FICO score and likely pretty high income. And so wealth management in a more meaningful way, as a percentage of revenue within the financial services segment, that's a big opportunity. And that's somewhere they could go next.
Do you believe that this is a company, and I'm just kind of throwing this out there as we're thinking about how they would achieve that. Do you think that comes through a merger? Is that their best way to be able to do that? I'm thinking of one company in Robinhood who's, had a very volatile, publicly traded existence here for, one matter or another, where we've seen their market cap slip down to about $8 billion here. So ultimately, I mean, even though SoFi's is only at about, $7 billion, maybe a little north of that at this point. All that considered, does this come through a merger? Does this come through a combination with another business that offers those very modules, or at least ambitions in terms of wealth management and trading and so forth?
I like the way you said modules there, because I think that SoFi is looking to grow organically first. I think that they believe they have a really strong member base that they can cross-sell at really discounted client acquisition costs. And so they really, really want to utilize that first. But at the same time, if technology is missing, if there's something that they can bolt on, I think that would make a lot of sense. I don't see a big transaction in the wealth management space or really any other product space for SoFi in the near future. That's my opinion, because I think that they're really focused on organic growth, and they're really getting these efficiencies in marketing spend to acquire new customers. And so I think that they're liking what they're seeing in their own productivity loop here, and they're going to keep utilizing it that way.
All right, Dominic Gabriel, Oppenheimer Executive Director, thanks so much for taking the time again. SoFi shares moving to the upside here this morning, up just about 2% following their earnings results. All right, we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. As Americans grapple with an uncertain economic landscape, credit scores are becoming a concern. 23% of Americans say a lack of credit or bad credit interferes with reaching their financial goals. This is according to a survey from the Harris poll. NerdWallet is looking to change that with the launch of its first consumer product, NerdUp, a credit card to help consumers boost their credit. I want to bring in Tim Chen. He's NerdWallet's CEO, joining us now. Tim, it's great to see you. Lots to talk about when it comes to the new product that you're offering. But first, I just want to zoom out a little bit and get your thoughts and your perspective on what we're seeing more broadly with the consumer. Because when you take a look at some of the trends that we've seen over the last several months, does point to the fact that maybe consumers are weakening just a bit. When you take a look at delinquencies rising, auto loan delinquencies rising, as well as credit card delinquencies. What are you seeing on your platform? What's your read of the consumer?
Yeah, the consumer is certainly facing mounting challenges. I think what we're seeing right now is really a normalization to pre-COVID levels in terms of some of the challenges we're facing. But yeah, certainly as we look forward, we continue to be a bit concerned as, student loan payments are coming back and it's getting tougher to get loans from banks. Insurance is getting a little more challenging given the inflationary environment. And we just really want to be there to help support users with the best information as it comes out.
Tim Chen, when you hear of conversations where higher for longer gets tossed around from the Fed, or even shallow or a mild recession, how do you translate that? How does that kind of transition over into your thought process, especially around what that means for credit scores and what products like NerdUp could mean for the significance of people trying to protect their credit scores?
So the thing to remember is that banks loan money, right? And higher for longer actually challenges banks a bit. It makes it more expensive for them on the depository side. It makes it a little bit challenging for them for the SVB-like reasons on the lending side. So they're getting a little more conservative, which means it's harder to get a loan now than it was 7-8 months ago. And so that really speaks to why we thought it was an important time to launch NerdUp. Traditionally, credit card companies make money on things like swipe fees, annual fees, late fees, and charging interest on balances. And a lot of people can't even get credit cards in the first place. So a secured credit card is really a stepping stone into unsecured credit. And we thought we could offer it at really good economic terms because we're already seeing millions of people come to NerdWallet looking for credit. We thought it'd be a great way to segue them into an unsecured product in the future.
So Tim, when it comes to the goal and how this fits in with your strategy at NerdWallet, how do you see this new card helping fuel some of that future growth at NerdWallet?
Right. So we really want to register users, engage them, and help them improve their credit score. So after 6-12 months, the hope is really that people will start establishing a credit history. I think people, especially like new immigrants, recent college grads, people with damaged credit, getting back into the system can make a big impact. Credit scores are essential in everything from getting a good car insurance rate to applying for an apartment to getting a credit card or a mortgage or a loan. And so this product really helps bridge a big missing piece of what we were seeing a lot of our users struggle with.
What are you seeing and observing in the trends of how often people are tapping credit right now as household balance sheets are certainly under some very scrutinous spending and spending patterns and habits right now?
Right. Yeah. So there's definitely you're seeing pretty broad trends coming out of all the pandemic stimulus that families benefited from. You're seeing declining savings rates, especially in the more challenged part of the populations. Right. You're also seeing increasing delinquency rates, increasing charge-off rates. That being said, it's important to really zoom out and look at this from the context of the past few decades. We're really normalizing towards more normal trends after a period of a very, very, very strong consumer. Things are still relatively strong on a multi-decade basis.
Tim, when it comes to where consumers are spending, how they're spending their money, what are some of the trends that you're noticing?
Yeah, so we're certainly seeing a ton of interest still in areas like travel, in areas like credit cards, personal loans. And then on the other side, consumers are really seeing the benefits of getting a new high yield savings accounts right now, right? Like long-term rates closing in on over 5% means that you're going to get some really attractive depository rates for the first time in a couple of years. And so both of those are top of mind for consumers right now.
What is the most necessary thing, not just from some of the regulators or policy makers, I should say, but also from businesses in terms of how they're engaging with consumers that can be done to make sure that credit scores on the other side of any recession, or perhaps in the best case, we see a soft landing that means no recession. What's the best thing that can be done to make sure that credit scores aren't so damaged on the other side of that?
Right. So, yeah, we also have a small business product where we really help small business owners do things like look for loans. And, so it's definitely a population that we think about regularly. I think it's very important to help consumers choose between different methods of paying for products, as well as to help them assess their different options. So, it's something we think about a lot.
In assessing the options of how people are spending and even which credit cards they're pulling out of the purse or wallet when they go to make a purchase, sometimes the rewards come into play, especially during a time like this. And in this environment, what are you expecting on that rewards front from what businesses are putting forward?
Yeah, so, credit card rewards have been getting increasingly competitive, which is a really positive dynamic for consumers for, past 5 years. So, credit card companies are really giving most of it back right now in terms of things like 2% cash back or big sign-up bonuses or, other really strong incentives for variable spending. And so that continues to be something we really encourage consumers to take advantage of. And then, of course, we've got the advent of buy now, pay later. And so there's just a lot of options out there. We definitely encourage consumers to track their budget via a 50-30-20 budget. 50% for their needs, 50% for their wants, needs, et cetera. And so we can really help you track that with our app and budgeting tools.
Tim Chen, NerdWallet CEO, always a pleasure to get some of your insights on where the consumer is spending. Tim, great to have you on the show here with us today. Appreciate it.
Thanks for having me.
Certainly. Well, today, President Biden issued a sweeping executive order regarding the safe and secure use of artificial intelligence, a wide-scale effort to impose nationwide standards on the fast-moving technology. The order includes calls for new standards around AI safety and security, legislation protecting Americans' privacy, and supporting workers as AI changes workplaces. We're joined by Arati Prabhakar, who is the Director of the Office of Science and Technology at the Technology Policy at the White House. Arti, great to have you here with us today. First and foremost, what are the key elements of this particular executive order that perhaps could shape where artificial intelligence is in the workplace, is in schools, is in the people of America's fingertips on a day in, day out basis?
It's great to be here with you today. Thanks for the chance to talk about this. It's a really big day at the White House. As you said, the president signing an executive order today that is the most significant action any government anywhere in the world has taken on artificial intelligence. Very much to your point, the president's been clear from the beginning of this work that AI is one of the most consequential technologies of our time. And he's also been clear from the beginning of our work with him on this that we've got a job, and that job is to make sure that we manage its risks so that we can seize its tremendous benefits. And exactly as you said, AI is already in people's lives today. It's in our work lives, it's in our personal lives, and we know that that's going to accelerate with the new advances that are coming. This executive order is about making sure that we lay a foundation so that we get AI right.
So, Rathi, how does this executive order do just that? What are some of the steps that you're taking, the priorities that you have laid out that helps to mitigate some of those risks?
Yeah, again, a whole series of different actions. The EO is broad, the executive order is broad because the technology and its implications and its applications are broad. One dimension, a really important one, focuses on safety. So how do we know when more powerful models are being developed? There are provisions in this executive order so that the government will be notified when companies build the next generation of extremely powerful AI technologies. We'll get access as well to their independent testing that they do on those models. That's important for awareness. But it's also about how the safety of cyber systems or how biological technologies are developed with AI. There are provisions here that allow us to get better at cybersecurity, that allow us to have a better handle on potentially dangerous biological work that's going on. That's all in the safety category. There are also provisions in this executive order that are about bolstering privacy. For example, provisions that focus on how the government uses data that it buys from data brokers. This is important to every individual's privacy. There are provisions about making sure we don't embed bias in algorithms. That matters if you're getting a loan. It matters if you're trying to get a job. It matters if you're involved in the criminal justice system. And in all of those areas, we want to make sure, and this EO takes the actions now to get us on a path where bias isn't going to get embedded. That's just a sample. There's much more that's about supporting workers as this technology comes into their lives, making sure government uses AI in powerful but responsible ways, and that we do the testing, the development of the technology, the standards that allow us all to know that AI is safe and working for us.
And Roughy, when it comes to the executive order that's been laid out, it has been criticized from some industry players, but also from some lawmakers as well. Senator Ted Cruz has been one of the vocal opponents, I guess you could say, or maybe one of the people that have been raising some of the concerns. He said that this executive order undermines exactly what AI technologies promise to do: create efficiencies, spur economic growth, and improve our lives. What's your response to that, some of the criticism that this executive order is getting?
Well, I've been in the science and technology and innovation business for my entire professional life, all the way back to when my hair was still black. That's a lot of decades. And what I'll tell you is that innovators and technologists, we're trying to do this work to achieve the great aspirations that we have as a country and as a world. But sometimes we get a little enraptured of the technology. And what has to come along with the technology is really thoughtful ways to make sure that we're using it in safe, really responsible ways that really reflect our values as a country. And if you step back and you think about it, every country in the world is trying to use artificial intelligence in a way that expresses their values. They're trying to build the future that they care about. The president has been clear from the beginning that we are living in a time in which American leadership in the world requires American leadership in AI. And that's about getting it right for the American people, and in doing that, being a beacon for the world. That's what this executive order takes a great step forward on doing.
Roughy, a portion of this executive order talks about supporting workers and addresses how generative AI and artificial intelligence more broadly is impacting jobs and workplaces. And also, at the same time, the same administration is also very much in support of unions and the ability to negotiate and make sure that the workers can identify and address where AI might be a companion or an augmented intelligence that they're working alongside, while at the same time protecting their earnings. But you think about the headcount that also could be impacted at many of these workplaces too. I wonder how the administration is thinking about that calculus and the kind of labor force participation that could be impacted where there are, in this case and even today, negotiations that net out for auto manufacturing facilities where it's known that there's going to be more robotics, it's known that there's going to be more artificial intelligence, and what impact that could mean for the totality of workers that are in that industry.
The work here starts exactly where the president always starts, and that is with deep respect for the dignity of work and workers. And he's been a tremendous champion for workers in every area. that's reflected in this executive order as well. And if, again, step back and think about what's happening. We've had generations of automation that have dramatically changed work. What's happening with AI, and especially generative AI, chatbots and image generators. Now, a lot of professions that no one ever thought were going to be subject to automation or having machines be able to contribute meaningfully. All of a sudden, we've got a whole new raft of professions where people are thinking about this, and we're starting to see some changes. So this is a pivotal time to get this right as this new generation of AI technology comes out and breaks into even more fields. So how do we do that? Well, first we start by understanding what it's capable of doing, and then taking very thoughtful action about how we can make this technology allow workers to do more and to earn more, rather than using this technology to surveil workers, to hollow out jobs, or to eliminate jobs. And we know the history shows us it can come out either way, and we're going to be very clear that we're taking the actions to get us on the right path for every worker in America.
Routhy, when it comes to workers, specifically AI talent, what exactly the U.S. needs to do in order to make sure that they have the employees that they need, that's skilled appropriately for the AI revolution, and what the future of artificial intelligence looks like? What are some of the priorities that you see the Biden administration doing or needs to do in order to make sure that that worker need is met here in the U.S.?
Yeah, I mean, we can talk about the technology all day long. We know that big things happen with great people. And so that's important for the country as a whole. And it's important for the talent that we're going to need inside of government as well. And this executive order has provisions on both of those topics. One set of provisions is about making it easier to get great people to come into the country from other parts of the world. That's a place where, of course, we've always wanted to be a beacon, and for decades, if not centuries, we have been a beacon for great people around the world to come to the United States and to pursue their dreams and to help build this country. We want to make sure that that keeps happening in this AI generation, and so there are provisions about that. And then turning to the important need to get great talents of all different sorts in public service. I've had the great privilege of spending half of my professional life in the private sector, in companies and as an investor, but also half of my professional life in government. And I can tell you that for people who are passionate about getting this right for the country, about achieving the big things that are possible with AI, one of the most satisfying things that you can do is to come contribute to your country by joining in this work. And so we'll be taking active measures as well to recruit and find great talent to move this forward inside of government.
Routhy Prabhakar, we thank you so much for taking the time to join us here this morning on Yahoo Finance, Director of the Office of Science and Technology Policy at the White House. Routhy, thanks so much.
Thanks so much.
That's all for us today on Yahoo Finance, but keep it right here because Rochelle Akufo and Akiko Fujita have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita along with Rochelle Akufo. Here's what we're watching at this hour. 3 for 3. GM's reportedly reached an agreement with the UAW, according to various reports, becoming the third car maker to reach a deal with the union. But after $800 million in losses following 6 weeks of strikes, plus the collapse of its self-driving investment, where does the car maker stand now? We're going to be asking that question.
Indeed, and 5.5 hours later, Sam Bankman-Fried took the stand, admitting to significant oversights in the collapse of FTX, but still pushing back on accusations of fraud. So will that risky bet pay off? We shall see.
Plus, big tech takes the stand. Alphabet CEO Sundar Pichai is set to testify as the tech giant's trial over its search engine dominance nears its 7th week. What the ongoing battle means for the future of tech.
But first, let's take a look at how the markets are faring an hour and a half into the trading day. We see the Dow here making strong gains here, up almost 1% on the day, or 300 points. The S&P 500, they're also up about 0.7%. Tech-heavy Nasdaq still seeing gains there, up 0.8% amid a very busy week for earnings, economic news, and of course, hearing from the Fed's decision. With that in mind, let's check in on how the Treasury market is faring. We're seeing that the 5-year, the shortest term, and the 10-year also up significantly. We see the 10-year had been dancing around that 5% mark a lot last week, pulling back though, but seeing some gains today, up about 1.2% on the day. The shortest term 5-year up just over 1% on the day, and the longest term 30-year yield, that's also up just over 1%. Well, we're about halfway through the third quarter earnings season, with 49% of the companies in the S&P 500 having reported results so far. According to FactSet, 78% of the companies that have reported had actual EPS above estimates, which is just above the 5-year moving average. Revenue, on the other hand, is lagging the 5-year average, with just 62% of companies reporting revenue beats. Still, the index is reporting higher earnings for the third quarter, with growth at 2.7% following last week's big tech reports. According to FactSet, if this growth rate continues, it will mark the first quarter of year-over-year earnings growth reported by the index since Q3 of 2022. So, can the momentum continue? Well, we have a few more big tech companies this week, and Akiko and I each have our eyes on one. So I'm looking forward to AMD's earnings. They're coming out on Tuesday after the closing bell. I mean, it's going to be a lot to digest here, because some of the growth that they've seen expectedly in client and data center segments are expecting to see versus last year, the same quarter, an earnings and revenue decline widely among the analysts that we've seen. But earlier this month, some positive note here, TD Cowen analyst Matt Ramsey said, after first half of 2023 characterized by the dramatic shift that we saw in generative AI, we view the headwinds as beginning to ease, as evidenced by the company's 3Q guidance issued prior to the earnings call. So certainly looking more bullish here. And keeping in mind, obviously, the chip industry, it is cyclical. But a lot of what I'll be looking for in the earnings call is how margins have been faring, because those have been under pressure. We'll be looking to see if the worst of that margin pressure is actually behind it. And something interesting here, Cathie Wood's ARC Q ETF on Friday, buying more than $5 million in AMD ahead of this earnings season. I'll also be looking to see what's been happening with global PC shipments, because a research from Gartner shows that those have fallen 9% in the third quarter, but they are expected to recover in Q4. So I'll be looking for any sort of signs of that recovery in what we see in the forward guidance coming out of AMD as well, Akiko.
Yeah, AMD always a good indicator of not just chip demand, but overall, as you point out, the devices demand as well. The stock down just slightly today ahead of those earnings results, but it is up more than 45% on the year. And to your point, this is a company, as with many other chip makers, that have gone through, sort of a bit of a show me period here, especially on what that demand and revenue picture will look like specifically on AI. So certainly expecting a lot of commentary on that front as well. Apple, the other big one, of course, that we are watching, reporting later this week. And, this is an interesting one, Rochelle, because yes, it is about the iPhone demand, and we're going to get to that in just a bit, but it's also about sort of the overall health of the consumer. We often look to Apple as a bit of a bellwether in some ways about where the consumer is willing to shell out, especially with those high-end devices. Now, worth noting that Apple makes up roughly 7% of the S&P 500, which is why we're watching it so closely. The company has already indicated they expect another quarter of declining sales. So if, in fact, that's where it comes in terms of these latest results, the Q4 results for Apple, that would mark a full fiscal year of sales decline. Certainly not good for the company. Investors certainly going to be looking also for what that China demand is going to be looking like, because that makes up roughly 10% of the overall revenue for the company. Some commentary coming through from analysts ahead of these results. JP Morgan, Samik Chatterjee, saying that he's seen a shorter lead time for the iPhone 15 when you compare it to where the 14 was last year. He doesn't see that as a good indication of demand for the 15. Also, Tom Forte, D.A. Davidson, a friend of the show, we should point out, says he doesn't think iPhone sales are necessarily going to be a big catalyst for the stock, certainly pointing to the fact that there could be softer demand. So another stock that we're going to be watching here on a very, very busy week for earnings. Taking a look here, the S&P 500 following the Nasdaq into correction territory on Friday, leaving analysts wondering, is this a routine dip or a sign of something worse to come for markets? Let's bring in Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Brian, is this a sign of things to come?
Well, I think that it actually is a little bit as far as these ups and downs. Oftentimes what happens is you get these market corrections driven by fears over growth, inflation, geopolitics, and then the corrections can turn into bear markets if those fears become reality. We think that we're going to be dipping in and out of these fears for a while here, so just expecting a little bit more volatility. So it's kind of one of those situations from a tactical perspective. We like the idea of, hey, maybe kind of buy the dip, but then sell the rip and just brace yourself for some of this volatility, probably until we get, let's say, into June of 2024, which is maybe the earliest at which the Fed would consider starting to cut rates.
So, Brian, with sentiment being where it is, then there's been obviously a lot of whiplash here, a lot of data for investors to have to contend with, on top of geopolitical concerns as well. How do you see sentiment changing in this period, especially as we have a very full week ahead, including what we'll hear from the Fed this week?
It really is. And so on our investment committee here at Annex, we are kind of looking at the calendar ahead. And really the big news is going to probably be the Treasury refunding announcement coming out Wednesday morning. Yes, the Federal Reserve is meeting on Wednesday, but it's pretty much baked in the cake what they're going to do, which is nothing. Now, the refunding issue, that's a little bit bigger issue as far as the amount of debt that the government is issuing. The Fed has stepped out as being a captive buyer of that debt. Foreign demand has declined, so households and investment funds have had to fill that gap. So if the Treasury comes out and if they are announcing that they're going to be really leaning on longer term issuance, that could be taken as a negative and you could have more of a bond sell-off. So that's probably one of the key drivers of sentiment. Now, thankfully, Treasury Secretary Yellen is absolutely brilliant. She knows this, and that's maybe why she's going to be biased towards issuing things that are more shorter dated, and we could get a bit of a relief rally, not just with bonds, but also with equities, if that is the case.
So, Brian, how do you position yourself in that expectation, particularly around fixed income?
In fixed income, we do like locking in these higher long-term rates. Bonds are very attractive if you can hold them. So when we look across our portfolios, some people, they have to invest through mutual funds. And so you get this mark-to-market, the ups and the downs. But if you can actually own the individual bonds, we find that to be a little bit more attractive, especially for individuals who are, say, in a higher tax bracket. Municipal bonds, preferred stocks, things like that can actually be a little bit more attractive, and we like to try to lock in those yields. So bonds are attractive if you can hold them as individuals. If it's through these ETFs and mutual funds, it gets a little bit trickier.
And what about equities? Obviously, we've seen a lot of valuations sort of going through the roof here, and of course, fueled by a lot of this generative AI fury here. But then a lot of people wondering, we're in the show and prove phase, especially when we're listening on these earnings calls. What do you like in that space?
Yeah, so we thankfully were positioned in a few of the names that benefited from that initial enthusiasm about artificial intelligence. It seems like it's kind of gone through this progression fairly rapidly about, okay, it's going to be the chip manufacturers, then it's going to be the device manufacturers, and ultimately it's going to be the users who benefit from it. And so the way that we're kind of positioning things is that as some of those valuations got a little bit more nosebleed levels for, say, chips and device manufacturers, to trim that and focus more on the longer term picture about who ultimately will experience those productivity gains. We found it encouraging when Microsoft reported how they said that users of their Copilot, about 40% of Fortune 100 companies who are using it, they experience some rather massive productivity gains. And so it's not necessarily, it's kind of doing this more like second and third round thinking. It's not just about, okay, who's going to make the chips or the devices, but who's going to be utilizing the technology. So when it comes to that, there are a number of names in the healthcare area and in industrials as well that we think could be benefiting from it, where the valuations maybe don't fully reflect those possible productivity gains.
Finally, Brian, roughly 80% of companies that have reported earnings so far posting beats. Your big takeaway so far in the season?
Yeah, so far so good, but really those big beats haven't been enough to really drive the entire market higher. We don't have this environment where it's a rising tide lifting all boats. Also, people are really hyper vigilant about watching the guidance. It's not just about what have you done for me lately in terms of third quarter, but what's coming down the pipeline in terms of fourth quarter and beyond. I think Facebook is a good example, or sorry, Meta is a good example of that. The numbers themselves were pretty good, but then actually on the call with the guidance that they gave, it was a little bit more sobering. And as a result, the stock reacted more to that. So it's really more about that guidance than it is about what they've done for us lately.
Will certainly be a packed week of earnings to look forward to. A big thank you there to Brian Jacobson, IXIC Wealth Management Chief Economist and Strategist. Thank you so much.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Nelson Peltz is getting a superhero backing in his bid for Disney board seats. Former Marvel Entertainment executive Ike Perlmutter has given his stake in Disney to Peltz's Trian Fund Management. Yahoo Finance's Alexandra Canal has the details. Hey, Ali.
Hi, Rochelle. And the pressure just keeps mounting for Disney. Ike Perlmutter entrusting his stake in the company to activist investor Nelson Peltz. Now, remember, Peltz launched a renewed attack on the media giant in October after launching a proxy fight against Disney back in February. Now, Perlmutter was ousted as chairman of Marvel Entertainment amid the company's mass layoffs in March, but he does remain one of the company's biggest independent shareholders. In a statement from Perlmutter provided to Yahoo Finance, he said, quote, "As someone with a large economic interest in Disney's success, I can no no longer watch the business underachieve its great potential. I urge Disney's board to immediately welcome one or more Trian board candidates, including Trian's CEO and founding partner Nelson Peltz, into the boardroom. I believe Nelson and Trian can help Disney's leadership better navigate the company's challenges and opportunities. Now, Yahoo Finance did confirm that Peltz's hedge fund had boosted its stake in Disney and that Peltz was seeking multiple board seats, including one for himself. And at the time of that revelation, Trian's stake was valued at more than $2.5 billion for more than 30 million shares, according to the Wall Street Journal. But this comes at a time when Disney has really struggled with multiple assets of its businesses. It's still not profitable on the direct-to-consumer side. The box office has struggled. We now have the ongoing actor strike. Disney on Friday delaying two major theatrical releases in 2024 to 2025. There's still question marks about the future of Hulu, ESPN, bringing that direct-to-consumer. And all of that has led to the stock price really suffering. Shares are down about 8% year to date, matching the S&P 500's year to date decline as well. And right now, a lot of analysts are questioning what the future of this company really looks like, especially under the leadership of Bob Iger. He has less than 2 years left on that contract, and he really needs to start making some decisions and making some moves. Succession plans, I mean, that's something that is a major factor for Disney moving forward. But a lot of analysts have told me that's really in the back burner right now. There are many decisions that this company has to make right now, a lot of problem areas that they need to fix if they want to improve moving forward. Of course, we'll hear from Disney in less than 2 weeks when they report both their fiscal year end and quarterly results on November 8th. But until then, this pressure from Peltz is certainly, going to impact the company in the future, and we'll see if it leads to any tangible changes.
Yeah, expect some questions on that earnings call, as you mentioned. Ali Canal, as always, thanks so much for that. Well, Sam Bankman-Fried's much-anticipated trial continues this week as the former FTX CEO takes the stand for a second day. Bankman-Fried testified for more than 5 hours Friday, admitting that he made, in his words, significant oversights. But he maintained he did not steal from customers or commit fraud. For more on where the trial stands, we're joined by Jared Lodehold, Ice Miller LLP partner. Good to talk to you today. So he's back on the stand this morning, but he was asked point blank by his own attorney, defense attorney, did you defraud anybody? He said, I did not. How convincing has his testimony been so far?
Not at all. The testimony, I think, has failed to really rebut what we've seen from all of the former executives that used to advise him, which he was very much aware, and in many cases, from what the prior testimony suggested, directed it. And so he's the only person who said he didn't do it. So I think we've kind of run into kind of a classic he said, she said. But, I think one of the things that I find the most interesting is someone who's kind of worked in and around FTX in the space. I've seen him be an incredibly engaged CEO on everything. And so the idea that, that much money was moving between FTX and Alameda Research, which I think is kind of at the core of this case, and he wasn't aware of it, is hard to believe. So we're looking forward to another day of testimony, but it's what I've heard from him thus far has not been that compelling or persuasive.
I mean, you're looking at some of the testimony here, SBF saying that he worked 23 hours a day as FTX was melting down. And also, obviously, some of his inner circle there really sort of throwing them under the bus, particularly Ellison there saying, it was more of an oversight issue, that he should have perhaps had better oversight, but that the intent was not there to defraud anyone, that it was more of a mistake. How do you think that's going over with, especially the jury? How's that being received?
I have a hard time seeing a jury coming to the same conclusion. I think everyday folks in their minds like, hey, if I lose $1,000 in my household, I know it, or 5,000, 10,000. So I think the everyday person on a jury is probably not going to believe one person when every person used to work for them has been cooperating witnesses, down to his ex-girlfriend who used to run Alameda. And she's been pretty unequivocal about this. And as, again, look, I see the graphic there, Gary Wang, who's a former CTO, who talked about how, he was giving Mr. Bankman-Fried the code so that Alameda had basically special access to customer funds. And so it's not clear to me how he's defining defrauding, but I think the bank records, there's ample emails. I mean, he looked for a general counsel who had, prior experience around money laundering cases. And I think there were memos that suggested that, how could he legally justify, customer funds not being in the where customers thought they would be. So again, the evidence seems to me to be overwhelming. I don't see any world where his testimony can overcome not only the testimony of former executives, but ample written documentation too. So I highly doubt that what he says will kind of move jurors or any other reasonable person on that.
Yeah, elaborate on that a bit, because anytime you have the defendant take the stand, it points to some risk for the defense. Have we learned anything new as a result of Sam Bankman-Fried testifying?
No, I think what you have is him rebutting what we all thought to be true, but his rebuttals aren't compelling, right? Because usually if there's ample testimonial evidence and documentary evidence, then there's usually some testimonial and documentary evidence to the contrary if you're trying to rebut the same that came from literally every person who used to work for him. I don't think we've learned much new other than he didn't think he defrauded people, but I don't think his definition of defraud is going to carry the day. I think it's going to be a fact finding by the jury that what he did was in fact legally defrauding customers and investors who never thought that the money that they were investing in the exchange would end up in some affiliated hedge fund that in turn would be, end up in his pockets or, political contributions and so forth. So I've yet to see anything from his testimony that will overbutt the volume of evidence to the contrary of what he's claiming in his testimony.
So, Jared, when people look back at this case and they talk about the repercussions, obviously at the beginning it was all about crypto and, his relationship with Binance's CZ and, there was a lot of drama around it, but when it comes down to it, this is about money laundering. What do you see the repercussions being for the crypto industry and perhaps future cases that come? Will they be compared to SBF, or would you think it will sort of stand alone?
I think what we have with SBF is really kind of standard money laundering and fraud, and the systems, I think, working the way that it should. The repercussions, though, downstream, I think, are significant in terms of reputational damage to the digital asset industry, particularly as Congress and regulators are still kind of mapping out what that regulatory framework will look like. And I think, unfortunately, the legitimate players in the industry are going to be lumped in with Mr. Bankman-Fried and FTX for the foreseeable future. And I think that is probably the most damaging in that what happened really didn't have anything to do with the underlying digital assets or crypto, but around these affiliated entities and money that, or, these are investor dollars ending up in the wrong hands, which is very classic textbook fraud, embezzlement, and money laundering. These are all the things that are pretty straightforward that I don't think really, in fact, kind of speak to these issues around crypto, but they'll be lumped in. Because I think for the average member of Congress and regulator, they will often look at the industry and paint with a broad brush and not just look at this case.
With that said, there's certainly been criticism about just how slow Congress has moved, regulators have moved in shaping crypto regulation. Now that we've had several weeks to process the information coming out of this trial, do you see any situation where regulation could have prevented what happened?
No, not this, because this is just regular fraud. That doesn't mean, though, that you shouldn't still be doing what Congress, the SEC, and other regulators are doing. And so fraud already has a fix. Unfortunately, it's after the fact, and it's what you're seeing right now. But I don't think there would have been anything that would have required them to have, again, basic risk management. But at the end of the day, if your CEO has decided that he wants to move money from one entity to another, there aren't really a whole lot of federal laws that can stop that, especially when what we're talking about, again, is just kind of standard fraud and money laundering. We have laws in the books for those, and those are being enforced now. But I think in terms of what Congress is doing, it always takes time for, I think, Congress to regulate. Now, the SEC has, the CFTC has, and the FTC has, I think. So you've seen the executive branch sound a lot more active. I think sometimes we have very Congress-centric conversations about regulation, but in fact, the policymaking is happening via regulation now. So we're already seeing Washington act, but in this particular case, I don't think you would have any of the things that are on the table in Washington now would have stopped regular fraud. And candidly, we have laws on the books that deal with that right now.
It certainly didn't help that the SEC and others were looking to SBF to help guide them in some of this regulatory framework as well. Appreciate you joining us this morning. Jared Lotholt, Ice Miller LLP partner. Thank you so much.
Thank you for having me.
All right, oil markets action ahead. Stay tuned. You're watching Yahoo Finance.
Time for today's trending ticker. We're watching shares of Panasonic, the Japanese electronics giant, which is also Tesla's longest standing battery cell supplier, announced it's slowing down battery production amid weaker demand for electric vehicles worldwide. Panasonic did note that electric vehicle demand in the U.S. remains steady, highlighting firm sales of EV tax credit eligible cars. The stock there traded in Tokyo, down about 2%, Rochelle, on the back of that. We should point out the CFO did highlight the impact of the IRA specifically, saying that they have seen sort of a ceiling because consumers have been going for the lower end vehicles, which have a higher tax credit there. That's led to concerns about what the demand looks like for the higher end Teslas because those batteries are produced in Japan.
Indeed, that $80,000 threshold, that ceiling that the IRA has, meant that a lot of those higher-end Tesla vehicles did not qualify. That dented demand, especially as there are more affordable options coming to the market. And Panasonic cut its full-year profit outlook at its battery unit by 15%. And it was tied to, obviously, Tesla being one of their most important clients, really putting a dent in things. But it does speak to this conversation that started to emerge about how perhaps people had misjudged just how fast EV adoption was going to be. We heard from the former chairman of Toyota last week, something of a told you so, saying, look, I told you that people weren't going to adopt it at this pace, perhaps wanting to stick with their traditional gas cars or opting instead for hybrids. So something of a rethinking that we might see here, although still seeing that adoption of EVs, but just not at the pace that they were hoping for.
Yeah, and we also saw GM and Ford as well scaling back some of their ambitions in terms of production of EVs. So it does raise the question about where that demand is or how much it will continue. Something, of course, we're going to continue to watch here. And speaking of GM, General Motors has reportedly reached a tentative deal with striking UAW auto workers, according to several reports, potentially meaning the end of a strike that has cost Detroit car makers hundreds of millions per week. Meanwhile, General Motors' driverless taxi service Cruise remains halted this morning after California regulators revoked its license over public safety concerns, prompting a nationwide suspension last week. Since acquiring the company in 2016, GM has lost billions on its driverless division. In the third quarter alone, Cruise cost General Motors more than $700 million, with losses topping nearly $2 billion in 2023 so far. Tech giant Alphabet, another company that's betting big on a driverless future, with Waymo. I recently spoke with Waymo's chief product officer about keeping safety at the forefront of Waymo's driverless technology. Take a listen to what he had to say.
Safety is the core of everything we do, and it's been the prime motivator for us ever since we began this, when this felt almost like a dream. And right now, the most powerful thing is actually we have published the results from our fully autonomous rides. From the first million, there were no injuries. There are no contacts with any vulnerable road users like pedestrians and cyclists. We have tested 20 million plus miles.
That's how many miles you've run in all the cities combined.
With a test driver, for example, even before we began doing all this, and that's more testing than all other companies combined.
So what does Cruise's setback mean for the future of driverless cars at large? Let's bring in Michael Wagner, the CEO of Edge Case Research, a risk management partner for companies building autonomous tech. We should point out, by the way, that Waymo is still operating. They haven't necessarily had the kind of issues that we have seen from Cruise. But now that Cruise has been halted, at least temporarily, how much of this do you see as a Cruise-specific issue? How much of this do you think can be applied to autonomous technology as a whole?
Yeah, I think it's reasonable to question the status of the autonomy technology itself. But I think if we look across the industry, things are progressing pretty well. I see this as being a symptom of perhaps poor safety culture at Cruise specifically. If we look more broadly throughout the industry, we do see folks producing data, talking about safety in a really meaningful and transparent way. I think that's going to be critical for getting out of this, because we are in a situation in the autonomous vehicle industry where we're kind of at the precipice of potentially something big, or maybe all having problems together.
And Michael, I want to talk about investment here, because there was a report from F Prime Capital that showed that significant decline in what we've been seeing with self-driving technology investments here. I believe they said down nearly 60% compared to the previous year. Is that a result of perhaps some of the shine coming off this rush there was into autonomous driving, or is there something else at play?
Well, certainly, I think it would be hard to argue against a little bit of the valley of disillusionment in Gardner's hype cycle right now. But I do think the other effect that we're seeing here is that the technology is getting ready to deploy. And so if you're looking at investments as a way of bringing in more research and development money to get the tech ready, as opposed to actually operating it commercially, that could be another effect here, because we are seeing the capabilities of these self-driving vehicles really start to get pretty complicated. But again, safety culture and safety processes are key. We have to be open about what's going on when these kinds of accidents do occur, because they will occur.
There is a question to kind of build on Rochelle's question there about how you make this a profitable venture. I mean, when you think about where we were more than 10 years ago, how many companies were invested in autonomous technology, I mean, that pool has really gotten much smaller as companies have sort of cut their losses. At what point, how significant does the scale need to be in order for this technology to be a profitable venture?
Well, it depends on the kind of application that we're talking about of autonomy. If we're looking at the trucking sector, I think many of the folks involved in that work see an immediate business need to start making money with autonomy today. If you're replacing, folks that are spending long days behind the wheel with additional technology that allows them to extend what they're doing or expand what they're doing in terms of hauling freight, I think there's a real business case here today. If we look at other kinds of applications like taxi applications, I think many players in the industry are looking at rolling that out at scale a little bit later. So some R&D is going to continue to be needed there. But I think, again, we really are at a phase where the technology is getting capable enough to start to do some simple kinds of things like point-to-point freight hauling that are going to start to build profitable companies. I've been involved since the beginning of this whole effort, trying to develop safety standards and safety practices to deal with some of the inherent issues here. And there really has been quite a bit of progress over the past couple of years in getting the technology ready for market.
So then is the next growth catalyst really going to be with fleets and freight versus, say, robo-taxis or sort of widespread consumer adoption of the technology?
Yeah, I think a lot of the big players are going to be looking, are talking about that sort of thing. And there are a lot of advantages. The traffic scenarios involved in highway driving tend to be simpler. The complexity of the task tends to be simpler. Obviously, we're talking about bigger vehicles at high speed. So again, safety has to be paramount. But I think we're going to start to see some real commercial progress move forward on the trucking side before the taxi side. So definitely keep your eyes peeled for updates from companies specifically in that sector.
Michael, I will tell you, as somebody who took that ride with Waymo, I mean, I on a personal level, very impressed with how much that technology has advanced, right? It was a pretty smooth ride in really the busiest part of San Francisco. But a lot of this is about autonomous cars coexisting with human drivers. I mean, when you think about the safety aspect, how much of this is also about human drivers learning to share the road with autonomous cars and understanding their habits, just like we understand the habits of other drivers?
I think realistically, there is going to be some human adaptation to the way these self-driving vehicles work. But also the inverse is really important too. And this is one of the big challenges, and it's been the focus of a lot of R&D, is having the autonomy understand what the behaviors of the human-driven vehicles around them, mean and look like. Because there's certainly a lot of context involved in everyday driving that we just kind of understand as humans. And this is especially the case when we're talking about busy neighborhoods in San Francisco or in other cities where there's a lot going on. And so I think that is really one of the big challenges that the technology is just, again, starting to be able to handle is not really what you're saying about us adapting to the robots, but really the robots learning how to operate safely alongside us.
Indeed, certainly some ethical decisions that people make when they're driving. Be interesting to see how that would translate for autonomous technology. Appreciate you taking the time to join us this morning. Michael Wagner, Edge Case Research CEO. Thank you so much.
Thank you.
Well, 2023 has brought with it a surge in labor activism not seen in the US in years. From Hollywood to Detroit, workers are walking off in pursuit of better benefits and protections, and healthcare workers are no exception. So far in 2023, there have been 22 strikes across the US. Joining us now with a deeper dive on this is Yahoo Finance's Anjali Kamlani. Anjali, I know you've been following a lot of this action for us. What's the latest?
That's right, Rochelle. We know that CVS and Walgreens are facing a 3-day walkout from their employees starting today. And that is going to really put pressure on what has become a very important part of the healthcare story. Going back to those 22, they've largely been within the hospital space, nurses in particular, demanding better hours, a better pay, and better safety requirements in the workspace. They've definitely dealt with a lot, in part because of the pandemic and in the subsequent years. And so what we're looking at is really along the coast, largely larger systems have been subject to these strikes. That includes New York and California. Kaiser, of course, we logged as the largest in history with 75,000 workers walking off the scene, and that ended in early October, so earlier this month. Meanwhile, Senator Bernie Sanders held a field hearing for the Senate Health Committee in New Jersey last week, targeting RWJ Barnabas Health. That CEO did say in his message to the committee that he respects what has been going on, but they're still in progress. They're making progress with negotiations. So this is really a story of post-pandemic when we saw the healthcare workers really applauded and lauded for their work, now facing the crunch of that. The pharmacy one in particular is a little bit different because we've seen that increase in interest in immunizations, more respiratory virus immunizations on the market now than ever before, RSV for one, including flu and including COVID-19, really adding to the level of work that these workers have. So they're demanding better pay, more staffing, and better pay for the technicians that do help out these pharmacists. So across the board, really coming to terms with how dependent we are and what level of dependency we have on these workers within the health system.
Certainly bringing that to focus. Anjali Kamlani, thanks so much for that. Well, all your markets action ahead. Stay tuned. You are watching Yahoo Finance. Well, one of the big questions we keep returning to this year, why is the U.S. consumer so resilient? The truth of the matter is we keep spending. Well, fears of a recession, spend. Mortgage rates rising, keep spending. And Fed still sounding hawkish, we'll spend some more. Of course, there are nuances here on what and where Americans are spending their hard-earned dollars.
Indeed. One thing is clear, though. Spending on having fun isn't going out of style. Our chart of the day tells the story. Spending in select categories from recreation to food service and accommodation is still going strong on an annual basis. The big question, can it continue in the face of higher for longer rates, diminishing savings rates, and student payments resuming? I mean, you figure if the fear of resuming student payments and higher for longer wasn't already starting to bite into, the consumer mentality, perhaps nothing will. I know this is something that has really confounded the Fed here, but it's important to also note that we're coming off of the heels of a pandemic. So this is something of uncharted territory from what we've traditionally seen when there's a downturn in the economy. So I think that's why perhaps it's a bit hard to navigate. It could be, spending to make yourself feel better, some revenge spending, but you have to wonder at what point that's going to kick in. Maybe after all the holiday shopping and the credit card bills come due again, but it doesn't look like it's making a dent at the moment.
Yeah, I mean, this points to this constant divide we continue to see, which is how consumers say they feel, the sentiment versus the consumer spending, where they're actually taking their action and spending their money. But Rochelle, you asked the question about, whether in fact or when in fact this is all going to start to hit the consumer. You could argue we've already started to see some signs of it. If you hear from bank CEOs, they've talked about more and more consumers taking on more credit card debt. And you also have this bank rate survey that came out more than 60%. So they have fallen behind on emergency funding or emergency money they've set aside. So Yes, in 2020, we were talking about the COVID money coming in, savings because people were going out. I mean, it's been more than 3 years since then. So you could certainly argue that it's starting to feel the pinch for consumers, at least in this data we got from the Commerce Department, not pointing to. But recreation, to me, was a little surprising because that you've got to be really comfortable, right, to spend money there.
It's true. I mean, we certainly saw it when people were spending on, Taylor and Beyonce tickets, but still willing to travel as well. Although some of that starting to pare back, but yeah, people really still holding on to that spending there. But because at first when I was looking at some of the spending patterns, I was like, is it just paying more because for your essentials? But when you factor in recreation, it just doesn't add up. It doesn't make sense.
Yeah, maybe it's just still that demand, the pent up demand that's still there, that's continuing. And of course, we talked all summer, as you point out, about people going out and spending on concerts and events and experiences. We'll see if that continues. Switching gears here, Google CEO Sundar Pichai is scheduled to testify today in the company's antitrust trial. The ongoing probe brought by the Justice Department and state prosecutors claims Google illegally used its power to ensure its search engine remained on top. The company currently holds more than 90% of the search engine market share. Pichai is expected to argue that Google's success comes from innovation and quality of its products, according to reports. Joining us now is George Hay, former chief economist for the DOJ Antitrust Division. Good to talk to you today. I went back and looked at the comments from you when this case was first filed. And I'm wondering, as you follow this case, now that we have seen the testimonies come through, has that really changed your view in terms of how strong the case is for the DOJ?
No, I don't think so. You have to appreciate that the preparation for this case doesn't go back 2 years. It goes back 15 years. Everything Google has been done more or less in the public. They know that they'll be scrutinized by state attorneys general, by the DOJ, by armies of private lawyers. They didn't do things which their lawyers said were obviously unlawful. So they committed this trial believing they have arguments for every allegation the government has made.
And how successful do you think they're going to be in arguing this, especially when you look at their increasing push into generative AI and really cornering that market as well?
Well, the basic argument, which the CEO will make, is that they're so big because they're so good. And there's probably an element of truth to that. Everyone would agree, I think, that they are the best search engine. The big question, the elephant in the room, is what about these $27 billion of payments to Apple and others? Google will say, we'd still be number one. And then the question, well, why did you pay out all this money? So I think the focus of attention is going to be on why they paid so much money if it wasn't necessary to make sure they remain number one. And also the risk of they'll play into the government's case on remedies. If they're convinced the court that they didn't need all this money to remain number one, then it follows that eliminating these exclusive deals won't necessarily hurt them. So if what the government has in mind is ending these arrangements, Google's testimony may help that argument.
George, how do you view that $26 billion, roughly? I mean, if the question is about whether, in fact, the consumer is harmed as a result of Google's dominance in the market, what does that money tell you about how Google has gained that position?
Well, again, it could well be that they're number one, and they will be number one, would be number one anyway. But those payments are suspicious. Do they freeze out the competition? Do they remove any possibility that competitors get a foothold? And so I think it could still be true that they're a very good search engine, and even without these payments, they would still be very strong. But these payments raise a question, and I think an important part of the testimony will be why we needed these payments, why, in what sense these payments are a good thing for competition, because the obvious implication is that it freezes out competitors.
And how critical is Sundar Pichai's testimony today to this particular case and to Google proving the fact that, look, we just have a good product. This is not about a monopoly.
It's largely an element of theater. Google wants to make sure the judge thinks they're not blowing it off, that they take these allegations very seriously. But nothing's going to happen today that hasn't come out already in the 3 weeks or 4 weeks of trial. All the documents have already been seen. I'm sure they'll cross-examine him with some documents, but they probably already would have come out in trial. And in any event, he would have seen them in his preparation. So I don't think that there are going to be any gotcha documents. I don't think there'll be any blockbuster revelations. It's simply putting a human face on why we did what we did.
And when you look at some of the 30-odd witnesses who are testifying, I mean, it includes not just experts and executives from Apple and Microsoft, also psychologists as well. What do you think what is the mindset behind including psychologists in this?
Well, the basic argument is that although the technologists will say you can just click a few buttons and get to another search engine, the psychologists will say, but that's not the way consumers behave. There's a lot of inertia. And if you're the default search engine, consumers are going to use you, even if there's a possibility that other search engines could get you what you need. So that's an important part of the testimony. Consumers don't always act in a purely rational perspective. We take the easy way out. And if the search engine is already there on my machine and hasn't given me any pain, I'm not dissatisfied with it, there's no reason to explore and navigate another search engine and learn how to use it.
I appreciate you giving us that insight there onto this case and what's going on here. George Hay, former chief economist for the DOJ Antitrust Division. Thank you so much.
Thank you for having me.
Well, amid all the tragedy and upheaval created by the COVID-19 pandemic, we also learned a great deal about the disparities in our economy, perhaps none more so than the disproportionate impact on Black-owned businesses. In the aftermath of 2020, Black business owners began to increase, but the need for structural changes at the federal, state, and local level hasn't dissipated. With that in mind, where are we now? Shark Tank star and entrepreneur Damon DeJohn has been a trailblazer for some time. His Black Entrepreneurs Day will return for a fourth year on November 1st. It's run in collaboration with the NAACP and sees Black entrepreneurs and small business owners across the country apply for a $25,000 grant, plus the opportunity to appear alongside Damon himself. So how far have we come? Well, let's get to Damon DeJohn, Shark Group CEO, to break some of this down for us. Welcome back to the show here. So talk about this day. And obviously this came originally out of what we saw from the fallout from George Floyd's death. So where are we now in terms of now post-COVID, the disparities for Black business owners?
Well, thank you very much. I mean, things are still the same. Actually, they may actually be getting, unfortunately, a little worse because there was a lot of people who had a pent-up frustration or they felt they weren't doing enough, a lot of the corporate citizens, and now they're pulling back a little bit. They've not totally abandoned, but they felt like, well, let's move on to other what they believe are critical issues. Okay with that, and with all the interest rates rising and some of the stuff you were talking about with consumers, they're questioning their position of where they lay their money. However, the same thing is still happening with, African American consumers. They're getting the last bite of the apple. They don't have as many resources, and they don't come from legacy wealth. Though it's kind of like playing Monopoly and never getting $200 every time you pass go.
Damon, you mentioned some of the sort of corporate initiatives pulling back 4 years into this. There was some concern on the back of the Supreme Court decision striking down affirmative action that this would kind of give cover for companies to say, look, we can scale back our DEI efforts because race shouldn't necessarily be a factor. I wonder, I know we're talking about entrepreneurs here, but I wonder if you have seen a direct effect there. I mean, what are you hearing from companies who are saying this is maybe not the #1 issue for employees anymore?
Yeah, I've heard that they just listen. It's a big world. And you have a lot of issues that people want to be part of, right? You'll have LGBTQ plus, you have veterans, you have handicap, you have a lot of other issues. So it's not that they have a bad intent. However, the studies have just, let's be greedy about it. The studies have shown with the diverse workforce, and if you look and think like the people you serve, that creates innovation and it's 18% more profitable to the bottom line. Right. So we are not even thinking about purely just from the aspect of is it the right thing to do? But there would be no FUBU if, I didn't work with other, cultures and manufacturers to create a FUBU or the industries that we see today. There would be no Sean Puffy Combs, Russell Simmons, Quincy Jones, and various other things. So you even talk about the gender. I believe that, and as you've been seeing, that women and African Americans get probably about 4% of venture capital. But when you look at technology that has broken down the walls, when you look at crowdfunding, we get about 30% of the capital due to breaking down the walls. So I think it's just in the best interest of the business's bottom line. And we're seeing that now, because if you look at the General Chase and Shopify, who've been with me since day one, their numbers have exploded. Lowe's, T-Mobile, and Trine, and we have new members like McDonald's. The first year our first year winner of a grant, Harlem Chocolate Factory, well, she's opening now in JFK International Airport, right? So we're seeing some of these seeds that have been planted 4 years ago, we're seeing them start to blossom. And that's where I want to concentrate more on the positive aspect of it.
And Damon, you raise an interesting point about Black Entrepreneurs Day, not so much about being a cause, but really giving normalcy, giving, the same opportunities that any other entrepreneurs should have. What are your expectations for where things go from here and what you'd like to see from a lot of these companies? I mean, considering how many people are applying for these grants?
Well, most of these people, or most of these organizations that I work with, JP Morgan Chase and the General and T-Mobile, they already have resources set aside. And that's the beautiful thing about this. Whether you win the $25,000 grant, and we have various amount of grants being given away, the resources are there. So you don't have to win something. You can go in and find things in one place. When you look at JP Morgan Chase, they have banks and bankers in the community. But me, even growing up, I didn't look at a bank as someplace that I belonged. I went to a check cashing place right next door. I paid 6% when the banker was literally in the bank so they can find a new Damon John before he or she is Damon John. Right. And when you have McDonald's trying to get new franchise owners. So it really is breaking the stigma of the African Americans who have been, or the perception where they felt like they did not belong. And there are these organizations and corporate citizens who do want to make a difference. So it's on both sides. Either you have the resource, you're giving it, or the community doesn't trust you because they've been let down so many times. But a company like Nike, they're always on the right side of the debate. And that's why they have this rabid customer.
Well, we look forward to the additional ideas to come out on year 4 of Black Entrepreneurs Day. Damon John, Chart Group CEO, thanks so much for joining us today.
And thank you for always supporting us. Thank you.
That does it for Rochelle and I in this 11 a.m. Eastern hour. We've got a bit of a rally on our hands with the Dow up now 350 points. Much more to come here on Yahoo Finance Live. Keep it right here.